Welcome. My name is Roy Maddox, and along with my son, Wesley Maddox, we are the host of the Charlotte Investors Business Daily Meetup group. We meet the second Tuesday of each month at between 7 and 9 p.m. The presentation tonight will officially close at 9 p.m., but we will actually stay online and talk stocks for as long as you want to discuss stocks. So many times we're on until 10:30, 11 o'clock at night. So just know that we'll be here answering, a lot of questions and discussing a lot of stocks. Let me tell you a little bit about the agenda tonight. The agenda tonight will be we'll be talking about the bear market rally that the market is currently undergoing. We will also talk about GDP growth and the implications of that regarding the recession that we're currently in. We'll talk about the unemployment news and the job report that was out last Friday. We'll talk about inflation. We'll talk about the lack of leadership in the market. And we'll talk about the time and magnitude of other bear markets that we've experienced in the past. And finally, we'll talk a little bit about the yield curve. That will be the first part of the presentation that Wesley will take us through. And then I will lead the second half of the presentation after about an hour, and we'll talk about individual stocks. Now, feel free to stop us, and we'll answer any questions that you may have. And we've put this presentation together such as it is to give you an idea of how the things that you should consider managing your own money. And this is what professional money managers look at by and large. So we wanted to share these concepts with you. Just to give you a little bit of background from me, I met Bill back in 1988 and with his protege, David Ryan, at a seminar in Houston, Texas in 1988. And I received a copy of their book. David, and the reason that I attended that seminar is David Ryan won the U.S. Investment Championship for 3 consecutive years. And I wanted to find out what this guy is doing. So he averaged 150% per year for 3 consecutive years. And he had a tremendous track record, went on to stardom at William O'Neill's sister company, managed money for those guys independently, and he also led the USA Fund, a growth fund back in the 90s as well. But that methodology that I learned from Bill O'Neill and David Ryan, it's equipped me over the last 35 years to really be quite successful in trading the market and investing in the market personally, along with my clients side by side. So we want to share those concepts with you tonight, so it will to hopefully equip you to become a better trader or investor, and reach the success that is obviously available out there to you if you're persistent and if you're passionate about the markets. One thing about this group is there's 1,500 of us now all across the country. And we're passionate about the stock market. We're passionate about trading the markets. We're passionate about our investing. We believe that can lead to a better life, a more comfortable financial security. And we want to emphasize that you can all do it. Many on this call are very successful as is, and we probably have a number of portfolio managers, maybe some hedge fund managers that are on the call as well, but we have many seasoned investors that are on the call. And we'll probably have, before it's over, we'll probably have about 200 people on the call, and hopefully we'll have input from all of you. So with that said, let's get started. Okay, we aim to educate and connect investors. That's our focus. We've really put this together because we believe in this community. And we're going to talk tonight about many educational concepts that really surround the William O'Neill CanSlim approach. So that's going to be our focus tonight. Of course, our disclaimer, anything that we talk about tonight doesn't represent a buy or sell decision. Please consult your own financial advisor in terms of evaluating any of the ideas that we talk about tonight. Okay, CanSlim. This is CanSlim is the acronym that Bill O'Neill came up with after a very lengthy study on determining the characteristics of the greatest stock market winners in the past. And each of the letters stands for really a signature item that great winning stocks typically have had in the past. Now, to bring this to current day, to what a current day stock would look like, these are stocks such as Google, Amazon, Apple, Netflix, Tesla, Broadcom, Priceline, on and on and on. So these, if you identified those stocks, you would have identified those stocks because they had these characteristics. And when Bill did the study 40 or 50 years ago, he found that these characteristics were relevant in identifying all the great winning stocks in the past. So basically what we're trying to do is we're just trying to pattern what we've seen before. And you can see the C stands for current quarterly earnings of 25%, A for annual earnings. And new is something that's important because the great winning stocks always have new products, new services, new conditions. So, Lantheus Holdings, for example, has a new medical imaging agent. Celsius is exploding on the scene with their energy drink. Shockwave is blowing out their earnings expectations because of selling their new devices, and on and on and on. So, we're searching those dynamic new companies with new products that can propel them for many years and multiple years of having great earnings growth looking forward. Supply and demand. Volume tells everything. And one of a number of the stocks that we're looking at that will show explosive upside momentum, such as Enphase, Shockwave, where they have gains where they go up 10% in price on volume, more than 300%. We think that's very important to look at. And we'll identify some of those traits in the second half of the program. We're always looking for the leaders. You've had many laggards that are down in Kathy Wood's portfolio, 70, 80, 90%. That's not where you want to concentrate your buying. The great winning stocks will be setting up when they're near or breaking into new high territory. So you want to focus on the stocks that are within 25% primarily of their 52-week high. This is where the new leadership comes in. This is where you find the Vertexes and the Shockwaves and the Enphases and the Celsiuses and on and on and on. Institutional sponsorship. We want to primarily concentrate on stocks that are followed by Wall Street. And, that's very, very important. And finally, the M of the whole formula has to do with market direction. Market direction, perhaps, is the most important concept, and it's the most important criteria because 3 out of 4 stocks go down when the market is in a downtrend. It's very difficult to find those needles in the haystack when the market indexes are under pressure, the way that they've been under pressure this year as we've traveled through the bear market. Okay, this is how our process runs. And we have found that this is very useful for individual investors and traders and portfolio managers as well. So we sort of put this together, and this is something that you yourself can implement and employ, as you make your trading decisions and investment decisions. So we call it the 3 steps of the stool of our process. The first is looking at technical analysis. And these And these terms can be found in books such as Edwards and McGee and many different books on technical analysis, where you're looking at the MACD stochastics, you're looking at relative strength index, and then of course you're looking at trend. And we identify the short-term trend when the market is in a short-term trend, when the 10-day EMA is above the 21-day EMA. The intermediate term trend is positive when the 21-day EMA is above the 50-day moving average. And the long-term trend is positive when you're above the 30-week moving average. And I like to see two closes above the 30-week moving average before I definitely say, okay, this market is now in a new long-term uptrend. When we look at the market today, you will see that we're bouncing back up to the 30-week moving average on lower volume. And we're right at a point where many of these bear market rallies typically fail. And tomorrow's going to be a crucial day because tomorrow is when the CPI is released. The last time the CPI released, that unleashed just a tremendous downtrend began again, and tremendous selling was affected because of the poor and high CPI number tomorrow. So we'll see, and we'll talk a little bit later about how that impacts the market as well. When we look at breadth, we're looking at the percentage of stocks above the 50-day moving average and the 200-day moving average. We're looking at the advanced decline line. We're looking at the new highs and new lows. No great new market uptrends ever take place when the new lows are exceeding the new highs. And that's the way that it's been this entire bear market. I think we saw yesterday, I think, was one of the first days where we had the net new highs higher on the NASDAQ for the first time, but they backed off again today with today's sell-off. And again, the percentage of stocks above the moving average, this just gives you an idea of context. And that context is important when you look at prior bear markets like 2000 to 2002, 2007 to 2009 to 2020, and now the current bear market that we're in. Sentiment can be measured by the National Association of Active Investment Manager Exposure Index. That allows you to see on a week-to-week basis what active managers, mutual funds, and money managers are doing and how much they're invested at market tops and also at market bottoms. The VIX indicator is a measure, we call it of fear. It's the volatility index. It's a measure of fear so that you can see contextually where that stands in when the market is complacent and where it stands when there's fear in the market. That's useful information to look at. And then we look at the put call ratio is another indicator that we haven't quite seen the fear and the panic that's typical at other bear market bottoms. And we may not see that remains to be seen, but we just haven't had the fear and the panic that we've seen at prior bear market bottoms. But we have had a tremendous amount of damage that's taken place so far. And we do look at some ratio analysis to see if growth is in favor or value is in favor, small caps, large caps, and so forth. Okay, this is just a summary of CanSlim again, and we get all of our fundamental information from really MarketSmith and investors.com. I've been a subscriber for over 3 decades of the newspaper, and from learning the process, their system, and just building upon their system, they provide all the fundamental information that you need to make an investment decision about your stock. So I think really investors.com is by far the best source of acquiring information about your stocks and all the fundamental information that surrounds them. And we also use MarketSmith. So we'll have a number of charts on MarketSmith tonight, and that's the screening software that I use. So MarketSmith is, I think, if not the best, it's certainly one of the best that you can purchase and subscribe to in the industry today. And we're subscribers, as many of our friends are. Hey, macroeconomics. Now, a lot of people don't talk about macroeconomics, but we get our macro theme from Keith McCullough of Hedge Eye Research. And he's got a macroeconomic model that has to do with growth, which is really GDP, the inflation forecast, and basically what Fed policy will be. So we think we're in an environment where the Fed will continue to raise interest rates, and inflation might be persistently higher longer than you may think, and it may be even more treacherous than you might think. And that's why Hedge Eye believes that we're in a quad 4 environment, which appears currently where growth is decelerating and inflation has peaked, but it's still going to be persistently high, like in the 70s. And so it's a very difficult time to make money because companies are warning. So the earnings estimates are being cut. Their slowdown is upon us, and the Fed is raising interest rates in a slowdown of the economy. That's a dangerous market to be in. Okay, quad 4 deflation, just a little asset allocation information. If we're in quad 4 deflation, then there's certain groups that typically are going to do better than others. And you can see on the chart here, you can go through those and see typically what does well based on where we are in the economic cycle. Okay, now let's talk about the bear market rally that we're in now. I'm going to turn the presentation over to Wesley right now. Wes, if you can take over from here, I'll stop sharing and then turn it over to Wes.
All right, thank you. So yeah, that was the acronym we're going through: guilty until proven innocent for this bear market rally. And so we'll start with GDP, then talk about unemployment, inflation, the lack of leadership. We'll go back through some historical bear markets that we've looked at a couple of times now, and then just yield curve inversion and how deep that has gotten recently. And it's a well-known lagging indicator that has gotten less attention recently, I think, just because of the strength of this rally. So with GDP growth, like we said, we kind of see based on our macro service that we use GDP growth slowing. This is the quarter-over-quarter seasonally adjusted annualized rate. So it's not exactly year over year, but you can see, the last 2 quarters negative. So some pickup in the back half of the year following those weak numbers, but then, based on their models, they're forecasting even worse growth to start 2023. And so, we're saying we're in a recession now. And I think we'll probably stick to that. But with that backdrop, it's going to be very difficult for some of these companies. And we've, if people think we're through the worst of it, we could see another further slowdown, or just a lengthy kind of recession here. We'll see though. But there's a number of headwinds still. See. Okay. And then
Wes, I got a couple questions on that slide.
Yes, go ahead, Larry.
These are Hedge Eye's numbers, right?
Yes.
What do the Fed numbers look like in comparison to this?
So that is a good question. I almost put it up here. Because they have the Atlanta Fed nowcast. That's the only numbers I really know. And they have a 3Q number. and they're saying 1.4% in 3Q. But that's as far as I know. I don't think anyone's particularly good at forecasting, but they are forecasting some growth in 3Q.
All right, thank you. And another question is I guess if you hear the talking heads on CNBC, all of a sudden they're coming up with language that there's a lot more to a recession than to downward, quarterly GDP numbers.
Right.
And given that, these are just slightly downward, and they're saying, well, since everything else is so strong, we're not in a recession. And I know that you're saying we are, but how do you feel about all those different numbers that all those talking heads are using to say that we're not in a recession, as well as our government?
Yeah, I think we shouldn't fall for it. It's kind of outrageous for them to try to do that. I think. Roy, do you have anything?
I think they're trying to redefine what has been described of the definition for the last 20 or 30 years, and because politically it's not expedient to do so.
Right. Yeah. And one of the things we've talked about a couple times is how technically that should be more bearish for the Fed outlook. If they're going to tell us, look, the economy's not even in a recession, then that gives them plenty of cover. And we'll talk about the unemployment too, how that kind of gives even more cover too, for them to keep raising rates aggressively, right? So if there's no damage to the economy yet, then there's no worries. They should continue to hike aggressively.
Oh, thanks, Wes.
Okay. Okay, yeah, and now for the U unemployment, like we just mentioned, we saw there was a really, really strong payroll growth number last quarter. One other thing, it's great that the economy is doing great, but that's a big number. And again, the only reason why we think about the importance of this is because of what it might mean for the Fed still. That's a great report. And notice that, we've been growing employment by, extremely high numbers, much higher than, prior decades. I think much higher than probably another, I have the history there. I think probably 15 years we haven't seen something that fast still. And with that latest payroll number, we're actually back at the pre-pandemic level. So the total employment, that's February 2020. The last time we had this strong the labor market was, what is that now? 2.5 years. And the unemployment rate also back at that level, about 3.5%, I believe now. So, the labor market's still super strong, but we need to remember that's really the lagging indicator of the economy, a very lagging indicator. And I think it's very clear from this chart. I think this is a great chart, how, unemployment is always amazing at the start of recessions, right? That's just before it starts to pick up. We haven't seen that pick up at all yet, but this is a really, really clear indicator just to show you how much of a lag it is. And, we'd expect it to pick up, I think, soon. We've heard all the announcements, all the hiring freezes at big tech and Walmart, and somebody else I think I saw this afternoon following the close. So that's really more important, I think, than the level here. Okay, and then so the big thing coming up tomorrow is the CPI report. We were 9.1% last month. So in June, when they reported June, it was 9.1. That was an all-time cycle high. And it was an acceleration, right? So it seemed, the narrative is that inflation has peaked, right? That's the hope. And we'd expect an 8-point something number. So some improvement in the inflation rate tomorrow, but we don't have very much net exposure going into this. We hedged with the Qs bumping up on that trend line, and with the I think the Nasdaq at that 30-week moving average that we talked about. That's Stan Weinstein's trend, long-term trend number. So anyways, we don't have a lot of exposure going into it because it's been such a volatile days following those and the Fed meeting. So we'll look for a deceleration in that. We'll see how the market reacts. I don't think we have a huge, a strong opinion either way, because and that kind of shows in our sort of net exposure here. But what I've done here, just to illustrate, how long it might take to get back to the Fed's target level near that 2% level. Right here's 2%. That's the target. I just basically what happened was from the bottom to the peak, inflation accelerated at an average of about 0.34% over the last 2.5 years. And so what I've done is just extrapolated. Let's say that we now decline at 0.34% every month going forward. I think I have us at 21 months forward to get back to that 2% level. I mean, of course, we'll look through that, but the point is, this might take a long time still to really, to see inflation slow, because of some components that sort of have a lag, like food and rent and shelter, that are still accelerating right now and may still accelerate, this month. So, we're in this kind of camp where it's going to be persistent. It just doesn't happen that quickly. It can't. It just takes time for things to flow through. And so that this is my unofficial forecast, my sort of very informal forecast of what this could look like. But then also Hedgeye, now we're looking at their inflation expectations as well. And they're different from the consensus as well. They're talking consensus being in the yellow from Bloomberg. So they're talking about getting towards 4% by the middle of next year. That would be, a lot of progress. And Hedgeye closer to 5% by the middle of next year.
Hey, Wes, Larry, another question.
Okay, and so now for the L and leadership, we're talking about lack of leadership, right? Yeah.
Wes, Larry had a question, I believe.
Oh, go ahead.
Okay, as long as you got the crystal ball out.
We don't hear you well, Larry.
No, all right, let me get back here. I forgot about it. I got to be right in front of my microphone.
Yeah,
Sorry
yeah.
about that.
Okay.
As long as you got your crystal ball out. Now, depending on if you go with the consensus or the Bloomberg or Hedgeye or even the Fed, which models might be better for stocks, and what are we as stock traders looking for if we were to have our crystal ball and try to get what we want?
And let me answer that, Wes, at the beginning. Okay, so even if the report, and I saw someone pitched in that there was no warning, there was a warning the last two inflation reports, the day before the report by the government, by the White House. So I don't know what to make of that. There's no warning. And so, what the market is doing, the market is trying to discount that the Fed is going to pivot and that inflation is going to come down more dramatically and more rapidly than these forecasts. And so the market is doing the Fed's work for the Fed right now. That's what the market is focusing on. And consequently, we've had this bounce off the bottom. Now, tomorrow, it's a long day. And then we have the PPI the next day. So I think the last time this was reported, it was the PPI that really turned, the market actually was up the day of the report, and then it turned over, I believe, when the PPI came out the next day. So it's a long day. If say the number is 8% or 7.9, I think the market will rally on that, and there will be we'll probably rally back up to the 200-day. And the shorts that we have in the indexes will probably get stopped out and cover those. But so that's what the market's looking for. The market's looking for a more friendly number, lower than you might think, because, you know, some of the components have really come down, such as gasoline, which is down about 30% from the high. You know, oil price, the price of a barrel of a barrel of oil is down from 130 to 90. So we have some disinflation in the system right now. So the market would want a friendly number, but if the number is persistently high, then you're going to begin the next leg lower in the market with a persistently high inflation number. So that's you know, that's how to play it.
Thank you, Roy.
You're welcome.
Okay, and so with L, we are talking about the lack of leadership, and it's been tough to make a lot of money on the long side. Just seen as that by that new high number, which hasn't really been blue since we peaked in November of last year. But we are seeing it, we've seen a little pickup in the absolute number. You see them new highs, and we had a couple of net new high numbers, very small still, but good to see. That's positive developments, obviously, over the last month with this rally. Some stocks setting up, but not a ton of new highs. And then to give us some more context again for the net new lows number, this gives you again the magnitude of the carnage and so many of the growth stocks that were high flyers in 2020 and 2021, and it's been nothing like we've ever seen as far as the persistence of those net new lows outpacing net new highs right there. And then this is just the S&P looking versus the New York Stock Exchange net new highs instead of the NASDAQ. Kind of tells a similar story, but maybe a little bit more diverse in the types of stocks that are listed there instead of the tech heavy NASDAQ. Maybe some very small positives, but the flattening out is again positive too. And that's green shoots that we're looking for.
Hey, Wesley.
Yes.
Hey,
Tom?
this is Tom. Yeah. Hey, there's a guy on Twitter that's pretty well known that talks a lot about net new highs.
Yeah.
And for the last 2 or 3 weeks, he's been saying, "Oh yeah, we're at net new highs."
Caruso, right?
Yeah, he's awesome. I love him.
Yeah.
But I look at stockcharts.com just like you've got put up there, and I've decided I'm just going to trust the stockcharts.com. And I'm guessing the data is not that different. He's looking at a more refined set of data. And do you guys typically stick with stockcharts.com data?
We have been. Yeah, I saw that too, and I wanted to. Because he uses Trading View, right? So.
Yeah, well, somewhere in the responses, somebody asked him about it, and he did give a pretty good response where he gets his data from. But I was just like, man, I can't get to that data. I'm using this data.
Yeah, sure. And Tom, let me just say as well that John Boyd provides that data on his Twitter feed as well. And, he's widely known for, interviewing, some of the greatest traders, on the planet. And he provides that information. He gets his information from Investors Business Daily, by the way. But we just, we're just looking for, it doesn't matter where you get the data as long as it's consistent.
They're usually pretty close. They're usually pretty close. But,
right.
But when you rattle off 6 days in a row and he's saying 6 days in a row green, I'm not seeing it.
Right.
We're not seeing it either.
Yeah.
Great. And we also check on FinViz, because I know FinViz will they'll consolidate everything, right? They'll look at every exchange on FinViz, but we don't have like historical numbers for that. We just look during the day.
Just to mention, the data he's looking at is not just NYSE. He's looking at all 3 exchanges, so NYSE, Amex, and NASDAQ.
Yeah.
and then he adds all highs and all lows. And you can do that on stock chart. If you use USHL symbol, it is available in stock charts as well.
USHL, maybe I'll
Yes.
add that in instead.
It's probably splitting hairs is what I'm thinking,
Uh-huh.
especially when it's right at the break even.
I actually asked him this question. He uses OTC tickers, and that's the difference.
Oh, okay.
And Brad also mentioned the Wall Street Journal as well as a good source.
Am I correct to say that it's kind of splitting hairs at this point?
Sure, I think so.
Okay. All right. Hey, appreciate it, guys. Sorry to interrupt you.
Oh, no problem.
Okay, so now to the T, time precedence is what we're calling this. This is a chart we've been showing for a few months now, to history of bear markets. 2022 highlighted here. It's red. We're calling it a bear or a recessionary bear market still for now. If it's green, if it's not, right, if we're going to say it's not a recession, then this falls just fine within the box of a normal recession. But again, this is the Dow Jones. And when you look at the NASDAQ, which I think most of us, we care about that much more than the Dow Jones nowadays. It's more on par with an average type of NASDAQ bear market, both in length and depth. So the NASDAQ being down 34% at the bottom, and
Right.
it's been about 200, maybe 200 and something days, 280 days, maybe. I can't remember exactly, but so that's something to consider. This is in part of the market, we've certainly seen a normal type of recession already, or correction.
Wesley, what's interesting about this? It's the pretty equal distribution of recession versus non-recession, almost regardless of where you are on the chart.
Well, Larry,
Oh.
the average bear market, and this is what is important, I think, the S&P was down 24%, and the average bear market in the S&P, you're down 34%. So if you're in a recession, we haven't had the magnitude of the drop that one would expect normally. And so the question is, is this going to be a soft landing, or will something like come later on in terms of when you're looking at Hedge Eye's numbers for the first 2 quarters of next year, where they're expecting -3% GDP growth. So, that's information that's not, that we don't have at our fingertips yet, because we don't know how that's going to translate. But I would think if the news is received badly tomorrow, then we'll probably have the beginning of the next down leg and have 3 down legs. But if the market, responds favorably, then we potentially could have had the bottom in, because we've had certainly enough distress in individual stocks and growth stocks.
That's an interesting point, because we had the same discussion on the last call, where the CPI number we had just seen, or was it the PPI number? One of the numbers, I think, was really, really hot. And our conversation would be, if it came out really, really hot, that would be a pretty good catalyst for going for the 3rd leg down.
Yeah.
And the market and the economy seem to be strong enough to withstand that number. So we're coming up against the same kind of story in this call.
Mm-hmm.
So isn't it likely that maybe the same thing can happen again?
It remains to be seen. It's your guess is as good as ours, really.
Of course, it remains to be seen. I mean, this is why we call this a probabilities game.
Yeah. I think we have to watch.
But I don't think that we can. I think we have to wait to see the reaction.
You do.
Very seriously, and let that percolate a little bit before we make any decisions, because past history shows us that there's a lot of strength in this economy, and there's a lot of strength in this market. And I just don't think it's as simple as we're trying to make it out to be.
It's definitely a complex entity for sure. It's a complex amoeba, if you will.
That's right.
Okay.
Thank you.
Let's see. All right. So when we look at history again, we just wanted to highlight a couple of these rallies and prior longer bear markets. Just because, like we said, we're not completely we had a tradable rally. We added some names and stuff, but these types of rallies are not unprecedented in bear markets. So this is the 2000 to 02 bear market, a number of sort of rallies, and the S&P 500 is maybe after today is up about 13% off the bottom. The NASDAQ was up about 21%, I think, off of the bottom in this rally as well. So, again, yet to be seen. But this is a normal. These are normal moves in bear markets as well. So, it was important to keep in mind. And then here we are with 2000 to 08, similar, look at bear market rallies throughout that. And you'll notice a couple of the big rallies where they hit the 200-day moving average, not quite there at the 200-day. And then this first rally hit the 200-day, 14% rally. But that's what we're kind of considering now, is whether or not this is. You just have to let the stocks lead you in. It's possible that the indexes keep going lower, and we can keep buying some individual names. We think we've identified a few of them, a few leaders. But it's possible that the indexes could work lower while some of these other names continue to hold up pretty nicely. And then here's a look at 2022, what we've seen, different sharp bear market rallies in the middle of this one, 14% from the bottom. And then this area here highlighted, this is where it was officially a bear market by the 20% decline definition.
And let me point out as well, guys, if you're following IBD, that we just put in a power trend. So a power trend, you can Google that and search for it on IBD, but we've had 10 straight days above the 21-day average, the 10 days above the 21-day, 21 days above the 50. The 50-day has turned up. And so that officially happened today. And the reason that I pointed out is that shows you that's how new bull markets breadth typically begin. But also I want you to be aware of, when you see that rally of 11%, that was a power trend right there in April. And we actually put on exposure and got stopped out within 4 to 5 days. And so, everything looked great above the 50-day moving average. The market's in this power trend, and it failed. So you've got to be on the alert for that. And certainly the last 2 days, you can see the last 2 days were very poor indeed, in terms of closing at the bottom of the day's range. So it's setting up. And that's why we shorted yesterday on the rally up, and we saw the reversal there. We just wanted to put some hedges on. Now, this bear market rally could go up to the 200-day. Say the news is friendly tomorrow, you could get a rally, to the 200-day before it's over, and then roll over as well. So keep that in mind.
Yeah. One thing here, we've been talking about needing a third leg down. I don't know if I didn't see this before, but maybe with this new month's data added here, it looks like we have 3 legs down. We just don't have a capitulation but that we would have liked to have like
You're
at
right.
the end of June.
You're right. And Roderick, did you have a question? Roderick, did you want to say something?
Yeah, I just wanted to bring up a quick point. I was going through my notes. I can't find it, but just as Wes is on this now, I think the average bear market rally, the S&P is maybe around 20%, and then the average for the NASDAQ's typically in the 30s. So if we're topping out here, just another point is that these rallies that we've had are actually weaker than what you've seen in the past.
That's right. That's right. Indeed. Indeed.
Just
And we'll
wanted to
see
point
that
that
when we pull up the current charts.
Yeah,
And
some of
you're
these.
exactly right.
Okay.
Yeah. Yep. Yeah. Okay. Well, so we'll go through these, which we've looked at before. So I won't spend a ton of time. I'll try to get through on these, but we're trying to, look at some analogs, try to think about where we could, what this could compare to in the past in bear markets. And so here we've got 2022 updated, looking next to 1962. 1962 having a retest in October. We've had a pretty strong summer rally here, so I mean, I would, we could see that retest in October. And then another comparison we've looked at is 1990 a few times. One of the things I was looking at with this 1990 and something that I think matters, October of 1990 is when the Fed started cutting rates. So I don't think that's a coincidence, but right in October, that was the first cut, and then they continued to cut for about 2 years following that. So that's a Fed pivot there, and kind of maybe fueled that quicker bear market bottom. Okay, and then just 1962 again. Again, we'll send these slides out, so feel free to take a longer look at some of these prior bear markets and study them on your own. 1970, this is one that had a much deeper leg down following the 20% pullback, which started the bear market by definition. 1974, also a bit prolonged. The bear market starting here down 20%, just to fall another, what is that, 30% from that point, and then just choppiness as it the bottom forms in bases. In the back at 2002, following the dot-com bubble, the end of it really, and just a lot of mess, a lot of choppiness and sharp rallies and over this 9-month or so period. And then 08 and 09, which we sort of touched on earlier, and the start of a bear market, and then a dramatic final leg or two down from there. Okay. And okay, so the last thing here, we're on yield curve, and so we're just looking at this closely. The implied Fed funds rate by December sitting at 3.6%. Here's the current target, 2.25 to 2.5%. That sort of topped out, it looks like, in June. Came down a little bit actually, and the rally really started in June. So maybe that's part of it. The expectations for the Fed have stopped going up, and so that's been enough for the market to go up in tandem. Okay, and then what I wanted to look at was the Fed funds rates next year. So this is from our last meeting, July 8th, a month ago. And then yesterday I looked at what we expected for the next months to start 2023. And so what changed from our last meeting? Well, December's Fed expectation came down a little bit from 3.73. Now it's 3.58% in December. The February number came down a little bit from here, but then we actually got a little bit higher for March, May, June, and July. It's still a downward trajectory, but those actually came up while these kind of earlier months came down. And I think that has something to do with the Fed's communication last press conference. I think they threw out a reasonable target, and I think it was somewhere in that 3.5 area. And so we've got a month off of the Fed funds, or the Federal Reserve meetings. And so for now, they're saying 75 basis points. We'll keep listening. I'm sure different speakers will, decide to say something here and there, maybe even following the report. Someone, I'm sure a governor will comment, but for now we're saying 75 basis points again in September. And so what does this mean like for the yield curve? We've clearly seen that all this inflation and Fed speak and everything has done some things to the yield curve. We noticed the 2-year continuing to climb higher. We're just holding up, I guess, a lot better. While the 10-year has, possibly peaked in June. And that's come down significantly, right? So we have the short end of the curve, which the Fed controls, and the long end of the curve coming down. We think because of recessionary fears, with the inflation thing not taking the not taking center stage here, but growth concerns really fueling the long end of the curve to go lower. And so we've got this yield curve inversion. 44 basis points. I wish I had done this longer term. I should have had the longer term curve, but we can pull that up later if we want to. But this is as deep as it's been in 20 something years, this inversion. And so that does typically lead a recession, right? I mean, it should pull in lending by banks, and it's just the bond market signaling worries about growth. And so yeah, this is a good leading indicator. It's not like you can really time things too much, but it's important to realize that what the bond market is trying to tell us.
And in the great financial crisis, we got down to, at the bottom, we got down to 51 basis points. I think you had minus 51 right before the market took it on its chin for the next 2 years. So, keep that in mind.
Yep.
If we're not, we think we're in a recession right now because we've had 2 consecutive declines in GDP. But of course, the Bureau of Labor Statistics, they're the people that will go back and tell you when we're in a recession or not. But that's after the fact. Typically, the last recession, the Bureau of Labor Statistics announced it 9 months after the recession was over.
Right. Yes. They will tell us late. It'll be too late. The market will have probably taken off by then. But yeah, I just want to pull this up. Actually, this 10s minus 2s, and see how deep that is. Actually, here's 0. Right, here's the inversion. We got a brief inversion in 2019, very briefly early to start the year too. And the last time we saw a major inversion was that 2006-07 period. So this is pretty, this is telling us something. Let's see. Okay, and so we'll continue just with some of the things we always look at. This is a net futures or net long positioning for futures. Actually, somewhat interesting. We've got a net short position and non-commercial futures positioning, and that's at a minus 2.2 Z-score. So it's at like the 90 or the 5th percentile, I guess, of short positions. So very high short exposure there. The NASDAQ still showing longs there, but these, the numbers that are 2 or above are really the interesting ones that are somewhat extreme. So we have the S&P 500. We saw the intermediate term trend change in our view right here with the 10-day over the 21-day. The 50-day is turning up, and that's pulled us in, and we've got some long exposure with that, right? The Qs, we mentioned that we want to, we thought that was a shortable position, bumping up on the on that trend line, that long-term downward trend line here. After this is maybe 20-something%, low 20% rally in the Qs.
And that demonstrates as well, that's either the 2 or 3 leg down. Larry, you mentioned that earlier. So that could be, there's 1 leg, there's 2 leg. You could say that's the mini 3 leg right there. But if the economy worsens and companies continue and demand destruction takes place and earnings have to come down, we view the reason that this market has rallied. There's always a reason that a market rallies, but this bear market rally has, and we could go up to 340 and still be in a bear market rally. It's because companies have all lowered their guidance and they hit their number. So they hit their number, and then Wall Street is saying, hey, we hit, they're better than expected. We hit the number. But when we look at individual stocks in the second half, the numbers for Google and Amazon and Best Buy and Microsoft are horrible. The numbers are just flat horrible. They're declining year over year and quarter over quarter. So you must be careful to not see what you want to see here in the market. The market's got something for everyone, and you need to make sure that you're not biased one way or another, because you've got to here. I think it's quite dangerous. And, there are a lack of setups. And I really feel like at every bear market that I've been through, and I've been through every bear market since '87, at the bottom, you had plenty of stocks to buy that were coming out of bases that had great revenue and earnings growth. We just don't have that many names right now. It's not consistent with what I've seen over 30 years in terms of just backing up the truck, because you have all these wonderful names. We just have basically, you can count them on 2 hands.
Yep. Okay, the FFTY, what we look at as a gauge for growth, not showing a ton of life off this bounce, certainly underperforming, up 10%, while the S&P's up, the S&P's up 14, but our barometer of growth.
And and we've looked at this before too, guys. This is as down as this is as much down. I think we're down 44% now. We were down 50% or so. And this it's like a 2-edged sword. You look at the damage, and that's been reflected in this index, and that's what's happened to growth. And on the other hand, it's potentially signifying bottoming action. And remember, this FFTY is highly rotational. The turnover is enormous. And we're, this would be a great product to add to your 401k, your retirement planner, things like that, because it's highly diversified and very rotational. And it's actively managed through their algorithm, unlike, say, ART, that the name that, her names don't change, and she's just averaging down. This is a totally different idea. So, but it gives you an idea of whether or not you should be making any progress or now. And this is showing you that it's, very difficult to make money in growth still.
Yep. Okay, in the IBD mutual fund index, showing some of the top managers that we pay attention to, and what we look to see, if they're holding any of the stocks that we're interested in. What was it? Down 35% or so at the bottom, but we'll see. A number of these have recovered, right, with this latest rally, and we've got Janus being a top performer here, down 11%, while most of these have been down 20%. But it's a lot better than what we were seeing. You know, we must have seen some with down 40% at the worst of it so far. Just, you know, similar to the FF2 line, how we look at in what we want to see if growth is really going to how growth is performing. All right, you know, when we look at the NASDAQ and the MACD, we got a buy signal according to MACD at the end of June, and that momentum has carried forward. Now, is this the price phase, or is this one the price phase? You remember?
Price phase is going to be the red one.
The red one. Okay, so we've been looking to see if that would turn down, but maybe this is, you know, cresting, I guess, with the latest 2 down days, but we'll see. You know, where we go from here. The RSI didn't really hit overbought territory. Didn't get, you know, above that 70 line following that rally here. Okay, and then what we look at again on trend is the moving average crossovers. We got that crossover here, kind of making a higher high right here. And that's kind of continued the trend. You know, the intermediate term trend has continued for a few weeks, and the 50 days turning up. And so, you know, our primary sort of guardrail that we want to look at is for us, for our kind of time horizon of trading, is this 10-day green line and 21-day magenta line. Okay, and we talked a little bit about this too in the last month, how we got really, you know, washed out according to this percentage of stocks above the 50-day, and we've you know, we've made some serious progress on that, and we're up at a level that really, you know, you want to be in if you want to have a sustained rally. Now we just need to maintain that, right? We need stocks to continue to stay above the 50-day, and then they'll, you know, start making new highs, and we'll have a lot more merchandise if this can continue from here. The 200-day, you know, looking at the S&P stocks and above the 200-day, you know, looks like we've bottomed in that as well. So some better breath from this measure as well, but it's just naturally going to take a little bit longer to see a better recovery. And then, you know, the same chart with the NASDAQ. It looks like we've bottomed here, just under 10%. So improving breath. We just, you know, we'll see if this can get any better, you know, even better, or if this can sustain at a level right here. And then the NASDAQ percent above the 200-day. So, you know, also seeing a bottom close to that 10% level, sort of similar to what we saw in 2020 and what we saw in 2018, just barely touching that 10% level for 10% of stocks above their 200 days. So, you know, a lot of these, you know, washout indicators have supported this rally, right? It was a bit oversold, and you know, we'll see if that's the ultimate bottom there.
And by that, look, you know, conversely, when you look at that, so that also tells you that 75% of all the stocks on the NASDAQ are under the 200-day. So, you know, rarely should you ever purchase a stock under the 200-day, because that's in a stage 4 downtrend. And so even after the rally that that's transpired recently, you've got 75% of stocks that are still in a bearish downtrend. So it's a very weak environment still. We need to get over 50 and stay above 50 before you really can build on the rally.
Okay, another look at breadth. We have the advanced decline line. Yeah, you know, showing a measure of how many stocks are advancing, but not much to glean from this. It's just kind of been in a sideways action. We wanted to confirm the uptrend. You know, we want to see a divergence. A positive divergence would be, you know, that the advanced decline line making a higher high, or you know, a higher low, while the indexes were making a lower low, for instance, but not a lot to I don't think take out of this yet. But from the advanced decline line on the NASDAQ, we drew this downward sloping trend line, and we were thinking that just if it could stop making lower highs, that would be positive for stocks. And we've seen that, right? We've seen this downward trend line finally break, and so just another a green shoot that with this latest rally too. Okay, and we already touched on the net new highs number. We looked at the 5 years, and here's 20 years. Just looking back, so we can get a little bit even more context here, just so we know, this period where we've actually surpassed that level twice, as far as the net new highs number, or net new lows outpacing highs. All right, and the VIX continues to trend lower the last 2 months. Something we kept looking for capitulation, right? We were saying maybe we'd like to see something in excess of 40 to signal the all clear, or that there was a capitulation event, and we really haven't seen that. I don't know. It's just steadily declined over the last 2 months while the markets have rallied. And just again, more context with the VIX and the S&P. We're below the 50-day, below the 200-day moving averages in the VIX as well. You could say that volatility is trending lower here. Okay, and then the active manager exposure that we look at. So we look at how net long active investment managers are. This was updated, I think, last week. So Tuesday usually gets updated. So we haven't gotten the latest data yet. But we, just to give us a sense here, we were close to about 20% net long with this indicator back in June. So we've seen managers start to dip their toe in the water too. It looks like it's been a little bit still a little bit tepid. It'll certainly be interesting to see when that latest number comes out for this week. It pulls people in, right? As indexes start to work higher, whether it's FOMO or general traction, it's just it pulls managers into this, and so we're still underinvested, and so we I think that's an important ingredient for a rally, right? I mean, if there's 45% cash still on the sidelines for these active managers, that could for sure just postpone the rally or prolong the rally, really. Okay, and then we've seen some interesting moves in the bull bear sentiment indicators here that we look at, the AAII bull bear sentiment. We've got bulls now at 31% and bears at 39%. So that's a net 8% for the bears now. You can see where we were not too long ago, where bears were outpacing by 40%. So it was like 60 to 20%, right? 60% bears to 20% bulls. Well, we've gotten a lot of bulls being created with this rally. So and price creates the narrative a lot of times, and price creates the sentiment. So naturally, we see the bullish sentiment picking up, the bearish sentiment turning down as people have watched their accounts grow. Okay, and with the VIX, we've got the put call ratio, or with the sentiment, we've got the put call ratio that we always look at. There's the 5-day moving average. I pointed out a couple of these prior spikes in the put call. We did see some spikes, but again, we were looking for something maybe more extreme. 1.4 may have not been the right number, just with these last two extreme spikes, but we certainly did not get that. We did not get that extreme fear capitulation with this indicator either. And then this similarly, just looking at the equity put call ratio, and let's see, we always look at the high yield spread to give us a sense of the credit markets. Big spike in early July, and that's just completely really crashed from that level over the last 2 months or month and a half, signaling that this is, I guess, what you might say the credit markets are working, which is what the Federal Reserve will say they're looking for, right? So high yield spreads are not blown out, or if they've kind of recovered here, it signals that, I think, to them, that the credit markets are still functioning, well, and there's not an elevated risk, at the moment. And then longer term, I thought this was an important level in 2018 because that's when they pivoted last. When at the end of 2018, we saw the Fed pivot on Christmas Eve, and we broke out of that level, and we didn't really get. I don't know if some people will say we got a Fed pivot. I'm not sure we really did, but anyways, there was it has not. It's come back below that level, that level of credit spread that we thought was kind of an important line for the Fed to pay attention to. Okay, we talked about the FFTY a bit. We're still kind of highlighting ARC, which was the growth bellwether. Interesting, that it was up 50% off the bottom just a day ago. We've seen so many of those beat up names rally really hard, Carvana, for instance, or I don't even Coinbase that they hold. Yeah, and then on the weekly, we've got longer term, just another, look at ARC, Bitcoin making a series of higher lows here. We've kind of thought that this could have been the capitulation event. They might be ahead of the game. We've seen the massive volume spikes lower. With Bitcoin, it's down 80%, or it was down maybe 70-80% at the bottom. We've seen a number of bankruptcies, and we're seeing forced liquidation in that market. So it'll be interesting if this one's just going to lead us out of this bear market, because it's still on the cutting edge. I don't think everything's a Ponzi scheme. Everything, or it's not necessarily all these coins are all Ponzi schemes, but just like the .com stuff, everything's 9% of these companies coins could go to zero, but it doesn't mean that.
Well, so quick question for you, and I guess this goes about capitulation for the overall market as well.
Yeah.
I see that the volume spiked, but it didn't line up with the low price. Is that something to be concerned about?
I think that's capitulatory volume. I mean, many times when you do bottom, just like when you bottom in the equity markets, it's a series. Again in 2007 and 2009, you rallied from, I think, July to October, and then you turned down, and then you had the final washout in the capitulatory bottom. And what I would like to point out is that if we had this type of volume on the markets, we would be 100% invested. And that's the only thing that's prevented us from, from having a higher investment percentages. Knowing that the economy is getting worse, knowing that even though the market's a discounting mechanism, earnings are coming down, and there are very few stocks that are raising their numbers, that are beating their numbers and raising guidance. But that's what you want to see in a bottom. So, let's just say we have a retest in the equity markets. You could have a retest in Bitcoin and it holds as well. There at that bottom, you had many people that were talking about 5 and 10,000 as the ultimate support. 12,000, 10,000, and so forth. But that volume suggests to me that we we indeed have made a bottom in Bitcoin. Not that we can't retest it, of course.
Yeah. Yeah. And this is so Ethereum. We don't have the volume, but it's same story really. But the difference here is really a lot of is outperformance. It's outperformed Bitcoin off the bottom. So maybe this is really the next leader. I don't really know what proof of stake is all about, but I know that's a big change to the network. Maybe that adds some, there are some benefits apparently, right, with changing from proof of work to proof of stake for that network. And we know it's more versatile. We know it's supposed to have some more applications other than Bitcoin, which is just to transact really. So clearly the outperformer from the bottom here. Okay, gold rallying, with rates coming down, I guess, but this one's been hard for me to crack, but looking at long term, this was a pretty looking chart, right? It was just many a decade long plus of a base and potential breakout that failed, but still that's an important line that we'll continue to watch. Yeah, and see here with the dollar peaking at the US dollar peaking at 109, coming down to 105, kind of moving in tandem with gold, or kind of I guess inversely, right, with gold here. And WTI, like we've talked about, looks like it's peaked. It's down 30% from the top, and this is right an important input to inflation and why we think inflation should probably be peaking right here. Natural gas, will it follow suit? Looks like a double top here as well. Natural gas. And then the 2 years and the 10-year, like we already touched on, the 10-year kind of peaking, we think from recessionary fears, and which is more important on the long end of the curve. 30-year, same kind of thing with the 10-year, that the long end, being driven by long-term inflation expectations and growth expectations. Okay, and then the yield curve, which we touched on, and then TLT being the inverse of the yields, right? So bottoming, right? Bonds moving up while yields are coming down. Right here, it looks like there's kind of a trend change here. Notice the 10-day over the 21-day back in July. It would be interesting to see treasuries start to outperform, right, the equities in the coming months. All right, and then this is kind of along with the equity market. We've got the high yield bonds and the junk bonds that we always look at, and if these will go, I guess, as the equity markets go, likely so. But just something that we can look at as a gauge of credit risk, and maybe this is important, right? We've got a lower high here for now. Is that I don't know, the rally's kind of run out of steam right there, with corporate bonds, but just one other gauge of the economy we're looking at on a daily basis. All right, and that will be all of those.
Okay, Wes, thank you, Wes, for sharing that slide deck with us. Guys, what I really wanted to stress and make sure that you understand is, look, coming out of this bear market, there's going to be tremendous opportunity. And I think it's the potential to make life-changing money coming out of the bear markets, where you can have triple-digit years. And I don't think this is going to be any different than any other bear market that we've gone through. If you identify the right stocks early, early in the advance, and you get some of these true market leaders that can truly change your life, you only need a handful of these to actually do that. And what we articulate and what we advocate is we want to have a 5% position. And in a good market where we have high conviction, we'll have a 10% position. But as an individual investor, all the money is made by concentration. That's one of Bill O'Neill's major tenets. Everyone that's won the U.S. Investment Championship or that's scored that's done very well personally, it's concentration that makes money. And so, I mean, many times, I'll have 20, 25%, in 4 stocks, but the market has been so treacherous where you've had to trade basically on 2, 3, 4, 5 days. And then the stocks have turned over. We've had very little follow through in the market so far. And again, we just from experience, and I remember going through 2015, 2016, where it was a very choppy bear market where you went sideways for a year and a half. It wasn't until January 17th, January of 2017, that the market took off. And stocks like, I remember we bought Square at 17 and it went to 100 eventually, I think in the next 12 months. So, you don't have any stocks with big, a lot of stocks with big earnings beats that are making new highs. And we are going to go over a handful that we think, and we certainly want you to pitch in as well, and see if we can identify, all the leaders in the market currently. So with that, let's take a 5-minute break and, get a soft drink, get some water, take a 5-minute, use the restroom and so forth. And we'll come back in 5 minutes and get going on the stock side of the program.
All right, we are seeing how it's doing. Which some of these other. This is a great. INMD has been on my watch list for a while. You see how it bounces off the 50-day? That's that.
And you'll see sectors
Okay, guys, let's go ahead and get started. And let me remind you that feel free, of course, to sign out whenever you would like to. The meeting officially is over at 9 p.m., but we'll stay at least another hour or so after that. But just wanted to give you a heads up. And this perhaps is the most fun of the entire meeting. It's when we get an opportunity to discuss like potential true market leaders and leading stocks and so forth. And we're going to share with you the stocks we own. So we all own these for our clients and also own them personally as well. And these are some potential leading stocks out there in the market today. And this is what leading stocks look like coming out of a bear market. And I guess the number one institutional stock in the market is Enphase right now. And you can see that the stock broke out on tremendous volume where the stock was up 17% that day, was up $38 that day. And the volume was up 317%. That's sort of one of those signature events. When that occurs, that's typically not a selling point, that's a buying point. So anytime you have tremendous volume where there's a catalyst and the stock is close to making new highs, those are the stocks that we're interested in. And so, Enphase is in the solar area. The White House, Congress just passed the Inflation Protection Act that's going to benefit solar and among other industry groups. But this is going to be one of the primary beneficiaries of the package, and that's solar. And you want to look and find who the leaders are. The leaders are the ones that are close to or making new highs. And this is the number one group. Number two group, I think. Actually, number one group in investors Business Daily and MarketSmith. So you can see that they just had a superb 100% earnings growth last quarter. Revenues were 68%. Remember, we're just looking for 25 as a minimum in most cases. And this is a stock that's got triple digit numbers. So that is really an ideal candidate. You can see that the group relative strength is A+. The SMR rating, which constitutes sales margins and return on equity. Look at the return on equity. They've got 91% return on equity. This company is making a boatload of money, and it's reflected right there in the bottom line. So the true past market leaders in the past, the minimum number that you would really look for would be around 17%. And this company beats in all the metrics. And we own this stock and we'll probably buy more. We're waiting to see what happens with the market tomorrow, but it's pulled back to the 10-day. And this is a stock that's going to go much higher. So if the market holds in here, this stock's going much higher. If the market's under pressure, you could pull back to the 21-day moving average and fill in the gap right there, which is about 255. So you've got about 13% downside. We considered taking this off the table since we've got a nice profit in it, but let me caution you, if we're in a new bull market right now, you don't want to sell, you don't want to take the first 20% and go to cash. I remember in 1991, I bought January 17th, 1991. That's when Iraq invaded Kuwait. And I bought US Surgical, Microsoft, that was converting from DOS to Windows. I bought, I think, Costco, Amgen, and these were all big winning stocks. And I recall back then, I wasn't very skilled in the markets then. I probably only had about 5 years in the markets at that particular time back in 1991. And I sold all these stocks when they made a 20% move, and I missed I missed hundreds of percent of moves. So this is how they take off. And this is what they look like. So this area, FSLR, First Solar, and these are American companies. So these are the companies that benefit. The Chinese companies, they're not going to benefit from the Inflation Protection Act. They'll benefit just because the group is strong, but they're not going to benefit with the tax credits. So this is a group, that's setting up as the leading group in the next upturn. And this is exactly what you want to see. You see these walls of blue. That's, this is higher than normal, tremendous accumulation that's going on, along with really good comparisons looking forward next year in 2023. So you can see the stock breaking out on volume. Again, with that 10-300, it was volumes up 400%. The price is up 12%. These are the stocks that you got to hop on almost immediately. And we're just waiting for this to pull back. We haven't added this one yet, but this is the number 2 stock in the group as well, with not quite the numbers that Enphase has, but certainly great numbers looking forward. That's the stock, the volume, the accumulation that institutions are attacking the stock with right now, that shows that this is a leading stock in the marketplace today. Look at the sequential numbers, 367 million to 621 million. These are big revenue numbers, and this is before the tax credits have hit. You've got a couple of names that are in the group as well that's going to benefit. For example, CEG, Constellation Energy. This is a beneficiary. And so if you go back and look this day, and you can do that on MarketSmith quite easily, and you want to look at the stocks that are close to a 52-week high when Manchin's plan, when they signed the agreement this weekend, but when Manchin had the deal done last week. So the stocks that were up the most on volume, those are the potential leading stocks. Those are the stocks that are first out of the gate. And look at these numbers in terms, these aren't small companies. This company is doing $20 billion in revenues. Earnings are going to be up $2.89 this year, growing to $4.50 next year. So when you look at something like this, guys, this has every potential to go to $150 in the next 12 months. So the same way that Enphase has the potential to go to 600. So, just because these stocks are high priced doesn't mean that the upside's not there. This is where the institutions are, this is where they're putting their money. So this group is obviously red hot, and those are just 3 names in that group. Another stock that we own is SWAV with the new device that cardiovascular surgeons and heart doctors, they use to reduce the calcium in arteries using shock waves. And notice this was an earnings report. So earnings, they blew the numbers out the gate. Earnings were up 900%. Revenues were up 100%. Look at the numbers. Look at the numbers over the last 4 quarters. And so 100%, 174, 157, up 900%. So this has the characteristics that many of the stock market leaders have had. And so now we own this going into the number, and we bought a little bit more today for new accounts. We'd like to have a 5% position, and really 10% if we can buy it right over the next few months, and we can average up in it. So these are the kind of stocks with no overhead that can double. and they have the fundamental backdrop, which is much different than buying biotechs, that many biotechs that don't have numbers, but have been very, very strong indeed. So Shockwave, no, and this is really sort of a crowded trade, guys, because I'm not the only guy out there that owns this. Many growth managers own this particular stock, but I'm looking to really get heavy in some of these names. We had Enphase, Shockwave, Celsius. We held this stock into the number. It started trading a little bit worrisome today, and we had a 30% gain in the position. And of course, this is the energy drink, and they reported they had a great quarter. We'll see if the stock is trading. It's up $2 after market. We'll see if it'll hold that gain. But this has also been one of the leading, I think, growth stocks in the market. And they reported earnings, stocks up 2 after market. But there was indeed a great deal of selling and distribution that took place. We didn't, if we didn't have a profit in this name, we were up in at 30% at the high 3 days ago. We would have definitely sold half or even paired that off. But we had such a profit going into it that we decided that, hey, you don't want to sell too early in these names. If it gaps up, if it would have gapped up like Shockwave, then we would be chasing it. But of course, you can see the triple digit numbers here. They signed a distribution agreement with PepsiCo. So, Coca-Cola has partnered with Monster. Celsius now has partnered with Pepsi. And there was a lawsuit that it was a competitor that's supposedly will benefit Celsius. So that's a positive as well. But they certainly have triple digit numbers and triple digit revenue growth.
Roy,
Yes.
I have a question. With the market being kind of dodgy, it could go either way. What do you think if you own a couple of these names, selling some to finance the risk and letting it go higher? Is that a bad strategy if they?
No, it's the strategy that I've employed in my personal account all year. But the gains, so many of these gains, there have been pops and drops. And if you want to get, we're trying to identify, personally, I'd like a 20% position here. It's a matter of getting in there. So the stocks that I've just mentioned, I'd have 20% in all these stocks if it presents itself. But the safe thing to do, particularly because the market is on shaky ground, it is to trade around your position. So, for clients, we're building portfolios where we're looking for big positions that can double or triple. You're going to have to, that's not going to happen overnight, but for a very adept trader, and was that Dana? Yeah, Dana, that's exactly a nice strategy to employ. Sell half, backstop the rest at break even, and see if it can turn into a big name. But you want to get more exposed to these names that I'm talking about. It's not like, someone mentioned Minervini, and we're a fan. We actually had a Zoom call with him. I think what's today? Tuesday. So we had a Zoom call with Mark on Thursday. Wes and I did, and that's how he trades in his Minervini private access. So he's
I've been reading his books, and that's why he talks a lot the progressive exposure idea.
And that is, and Icon. I heard an Icon. No, it was Soros. A Soros video the other day. You shouldn't really. I view where we are. We're 1% net long. We've got 12% short and 12% long, and we could get kicked out of the shorts, tomorrow, and our longs could hold in there too as well. We could be pressing our longs and taking that exposure off. But here, after a bear market, you only want to put you don't want to guess the bottom. You know, we didn't guess the bottom when the market bottomed a couple of months ago, because we didn't have what exactly we're looking for. And that is the capitulation event. And it just didn't happen. And it's happened every other bear market for, with what we've looked at. So we weren't confident that that was the exact low, and you didn't have any stocks to buy. Even after this rally that we've had, there's just a handful of stocks that look good in terms of buying. So I don't think that it's really a healthy market yet, because the internal statistics are so weak in terms of new highs and new lows. And remember in 2008 at the bottom, when you bottomed in, I think 2008, it took another 4 months before you actually had a number of stocks that were building bases and breaking out of strong patterns. And by strong patterns, I mean in uptrends, stage 2 uptrends within 25% of their 52-week high that really had tight action, not wide and loose action. And you have to, you know what that is when you see it. So
Hey, Roy.
yeah,
Go
ahead, Charlie.
Yeah, so you said you were up 30% on Celsius at the highs. And
yeah,
I'd be curious, if you're up 30%, I was calculating, where would you be buying the stock? Because it's kind of hard to get in on this one.
It is. I mean, I think we probably bought we bought in the 70s. So you can see the resistance there at 72.01. I'm not exactly sure where we bought it. Well, we did buy the stock in the 70s. And so we probably, we bought it. Wes, do you remember where we bought it actually?
I mean, no, you're right, in the 70s. I don't remember.
Somewhere in here, Charlie, when
You bought it at, this is Sam, you bought it at 79 and change.
Okay, so bought it at 79 and change. Okay.
Uh-huh.
So must have bought it this day, see, coming out of the pivot.
Got it. Yeah, I see that little consolidation pivot. And if you don't mind,
yeah,
could you also go to WAV and ENPH and highlight where you bought it there? Just
on what ENPH?
Yeah, ENPH and Shockwave. Just those two names, please. Thanks.
I think we had the position. We bought the position back in the consolidation. You see that 217 pivot?
Yeah.
We probably bought it. We bought it right in here as it got
227.
What time?
227.
Okay, 227. So we bought it the day that it looks like
right on the open.
Must have bought. Well, there's 225, 226.
Right.
So and I don't know if that's the average cost, Sam, or was that one purchase, or did I've purchased this twice, I believe. But we definitely owned a little bit of the stock. We owned the stock before, I think, this breakout, or we bought it on the open when they reported earnings, like right in there.
So you bought into earnings. Did you start with a small position and then averaged up?
We have a 2% position, and we'd like for it to be 5, 5 or 10. If we had conviction with the market, we would have a 10% position. I mean, this is a stock that we truly think can double. So we would like we would like certainly a 5% position.
Uh-huh.
And, take it up to 10 as we average up. Remember, if, these true market leaders last an average of 8 earnings cycles when they make new highs. So that's about 100 and.
Right. I think Jim Ripple says it's like 96 weeks is the average true market leader.
Okay, so and we came out, it's like 100, that's 13 times 8, which is 104 weeks.
Yeah.
So and we're looking, and Ropel's in this. I know he's in it, so Ropel's in, he's got
Hey, Roy.
Yes.
Quick question on Enphase. So would you add more at the 10-day or at the 21-day?
Well, the strongest stocks, when they break out, don't go to the 21-day. So we had to make a decision today of whether, going into the number, you know, if the market reacts positively, we're buying, we're adding to this position tomorrow. We're going to take it up, and we'll see if the market, you know, sells off. We're going to see how the stock reacts, and depending on how bad the sell-off becomes, it could go to the 21-day. We will be buyers at the 21-day. I'd like for the 21-day to be higher, though, Amit. You know, I'd like the 21-day to be higher, and it will catch up. You know, I'd like to be buying it, filling in the gap at 260 instead of, where the 10-day is, and the 10-day is at 278. You know, that's $28 difference in price, but we want to get progressively longer there. And we've got the last one was Shockwave, and we bought this stock. Sam, do you have that cost, Sam, handy?
Yep, hang on.
Okay.
I'm showing the purchase price at 209, 210.
Okay, so 210.
Looks like right through that three-touch trend line, right?
Yeah, yeah, right there. Let me see the low. Yeah, right through there. What we bought it breaking the trend line right there.
Mm-hmm.
And again, we just have a small position, and for recent clients that didn't have the position, we bought a 1% position today to get it on board. And if it'll come into 250, we're going to start buying. Wes and I have already talked about this, about adding to this position. So truly great numbers. Now we just want to get a position that's meaningful, that can move the needle.
I don't want to contribute to gossip, but my husband works in cardiovascular. He said Shockwave does a procedure. So the atrial fibrillation and some of the issues that people are having from post-COVID and vaccine, that this is a medical treatment for that. So they're starting to see more cases that
Really?
need this. Yeah.
Well, that's interesting. We actually, we just opened an account with a cardiologist. Wes, where is he? Where was he?
I think it was Nevada or Arizona.
Yeah,
Somewhere
Nevada. Yeah, and he actually uses the device, and he moved a lot of money to us because I mentioned this on Twitter, and I've written about it on Twitter for the last few months as well. And by the way, you can find me on Twitter at Roy L. Maddox, and Wesley J. Maddox is on Twitter as well. And what we're doing, we're trying to be very, very transparent and sharing on Twitter exactly what we think about the market, and also what we're buying as well. So if you read my comments on Twitter, that's exactly what I'm doing in client accounts, by the way. Okay, so some of these.
Roy, sorry, Roy. Question on Celsius before you go to the next one.
Okay.
Do you know why it dropped so much with such a heavy volume today, as well as day before yesterday?
Well, this is my guess. Monster missed last week. There's Monster Beverage. So, the energy, Monster did not hit their numbers. Wes and I were talking about this because, Pepsi just signed the agreement with Celsius. Indeed, growth is going to accelerate just by having Pepsi as a partner. So I think it's just people were scared of going into the number because Monster missed. And, Monster's been out there for years and years and years. And the stock made a new 52-week high, then it rolled over, and there's the earnings miss. So you want to see Celsius hold its gains tomorrow. Otherwise, we could, if it doesn't hold the gains, we could be sellers tomorrow. But if it holds their gains, we want to get more involved in this stock, because we think the runway is extremely long. And this is what market leaders look like coming out of bear markets. These are the first stocks making new highs. And you can see, you know, this stock's just breaking out. So this stock can easily go to 200 to 300, 12 to 18 months if if the numbers continue to support their growth. So, I mean, these are phenomenal numbers. We'll just see how the market reacts tomorrow. This is something also that we'll be watching this 21-day to get involved tomorrow. Let's say the market gaps down 200 on the NASDAQ. So this is something that might provide an opportunity, if the stock's down 4 or 5 on the open, because the winners are, the true market leaders, when they are going to, they're going to perform better than the overall market. You have to be careful here that you're just looking at the averages, because we don't like many of the stocks in the queues. Like, for example, let's just take a look at those. There's Google with the -1% earnings growth, 13% revenue growth, relative strength of 38. We think this goose is cooked. There's Google. Let's look at Amazon. Amazon's got a relative strength of 73. They've lost money the last 2 quarters. It's a big company, no growth, 7%. We're looking for the companies that have. We're looking for the companies that have the biggest and best numbers. So there's Amazon, Google, everyone's favorite Apple. Apple lost 8% this quarter. These are not good numbers. And I don't care what the talking heads on TV are telling you or what you hear. If you hear Kramer say that this is, that these are a great quarter, these aren't great quarters. They're lowering guidance, revenues are declining, earnings are declining. This is not an environment that's conducive for growth stocks. I mean, these just aren't growth numbers. Amazon, Google, Apple, who am I missing? Tesla.
Facebook.
Tesla's got Tesla. Who's that, Brad?
Facebook.
Yeah,
Facebook,
well, I'll pull up
Meta.
Facebook. Yeah, so there's 80%, of course, decelerating numbers here. And we're just not value players. We're not value buyers. We're looking for the stocks that have great numbers. And META. This is not a stock that you want to own. And you'll hear people on TV, particularly people like Stephanie Zink and other commentators, that they're buying this stock. Josh Brown buying it on the open when they missed. This is exactly what you don't do. You don't buy stocks. Let me just give you one very important piece of advice. You really want to buy stocks that beat and raise their numbers. That's the catalyst. That gets the institutions involved. You want to buy stocks that beat and raise numbers. And you want to sell stocks where they miss, and particularly stocks that miss and they gap down. That's your perfect shorting opportunity, if you want to play the short side. But the numbers here are abysmal. So don't get caught in the value trap thinking that this stock will double from here. This stock's going to be years from doubling, based on their guidance. And this is one that we owned and we got kicked out of right here on this volatility day, this wide volatility day. They've got a medical imaging agent that is widely received, particularly for prostate cancer, actually, and it gives you a better record of identifying prostate cancer. And it's got triple-digit numbers. Look at these. Look at the numbers here. And this has been a very difficult stock to be in, and we've been in this stock a couple of times and gotten stopped out. And we actually got kicked out of this 3 days ago on the wide volatility upside day to the upside, and then a downside day, the same day.
did the same things, but the stock. I know what he's talking about.
Yeah, who made that comment?
I was talking to you. Well,
Huh?
Let me see. I don't know if someone had a comment or if they just were muted. Let me see. I didn't see. But this, so this stock has the type of profile that you're looking for. It's just wide, it just had a wide and loose day. And this is, we're gonna try this again. If the stock will pull back and get tight, we'd like to enter this stock again with the numbers. The numbers were fantastic.
Roy, would you just have a smaller position on that so that you can handle that volatility, that swing?
We had a smaller position, Brad, and nevertheless, we've been real adamant about not taking more than an 8% loss.
Okay.
And we didn't know if it was going to take out that 50-day, it snapped back. If you look at the day, that's how wide that's what happened that day. So we actually, you had this wide day, it snapped back, and we sold it probably mid-range. We sold the stock mid-range because of the volatility. Great stocks don't act that way. They don't act that way.
Roy, on the earnings day, I tried to buy this through 80 on that volatility day, and I was stopped out maybe like 2 minutes later with a 2% loss, and I was and then I said, I'm just happy my stop filled.
Yeah, notice notice we looked at a couple of these names like Enphase, where there's the buy. See, this was turning out to be a 10-300 to buy, like on the open. And that's the 10-minute chart. And then, the second 10-minute bar, it just, came unglued. Minervini actually, he owned this too recently, and he got kicked out that day as well. But that's not what great stocks.
Yeah, I was about to say that was like a warning signal. When I saw that and I see that ugly daily bar, I'm like, I don't know, this thing might be done. I don't know, but we'll see.
Yeah, Wes and you hit the upper trend line right there, which was a potential sell signal. You see the trend line there. It was a potential sell signal, and Wes and I were debating, do we want to take the position higher because it was setting up, as a 10-300 day, on its way at a new high. The earnings are out; they were well received, but somebody dumped it. Somebody dumped it into the earnings report. Here, let me. So those are the primary ones. I'll point out a couple of other stocks that are setting up. We got kicked out of this Vertex about 2 weeks ago because we had a very small loss, and we decided to take it, and we didn't know if it was going to hold this 50-day or not. This has rallied back, and we didn't want to go through the number. So we didn't want to take it down. We didn't want to take the stock into the number, but the stock has reacted positively after the number. So we're looking to add this stock back. So it's the number 3 group. You can see medical biotech. It's one of the leading stocks making a 52-week high. The quarter's out. Very solid blue chip numbers. Very strong numbers. So you want to keep this on your radar as well. If it'll get tight in here, and if the market reacts favorably, we'll probably add this tomorrow. If the market gaps up, we'll probably add this back right there, coming over 300 right here. In that group, and I mentioned this. Let me see. I don't know. I hear some background noise. Can you see who that is? Does anybody see that?
It looks like it might be Hong Jin.
Okay, let me see. I've got a number of pages. And how do you spell that, please?
It starts with an HONG.
Okay, HONG. Let me see if I can find them. HONG. Do not. Well, he's no background right now, so he's fine right now. I couldn't find him. We have so many people on the call tonight. This is a stock. I'm going to point out a number of these stocks, leading stocks in the biotech area. And what we're focusing on is the stocks that have good numbers. The stocks that have good numbers. This is this is one of the leading groups. And this stock just broke above 100 on the earnings report. And I mentioned that breaking above 100 would be, a good place to enter into position. We just didn't want to take any exposure going into the CPI number. But this is a stock we're looking to buy on a pullback. Very solid earnings numbers, very solid sales numbers, a $10 billion market cap. Stock's breaking out. You can see the last 3 days. Institutions have been accumulating, so this is on our target list. Let me see this ALNY. Yeah, this stock came out with a new procedure. They're in the gene editing area. They're in the gene editing area. And there was a positive release from I think a phase 1 trial, and the stock had a tremendous move on earnings. This is also giving you that signature. They're doing about $1 billion in sales, very high price to sales multiple, however, but institutions are piling in. And so many times you would look at something like this and say, man, this stock's up 49% in a day. I'm not going to buy it. There's no way I'll buy it. But, I actually bought it and got kicked out the second day. I bought this personally. The second day when it opened down and hit my stop, I had a stop at 198. That's me getting stopped out right there. The first on the open, and I was the sucker, that day. But it doesn't have the earnings profile that I'm looking for what we're doing, in our fund. But it's got the profile for what I'm looking for a speculative momentum type blast off move. This SRPT has got very strong action. SRPT, they're not making money, however, but the stock is showing its leadership. And look at notice the bars of blue here. See, this is being accumulated. So many times, the CanSlim formula stipulates that you should have earnings growth. But remember, Amazon didn't have earnings growth for 10 years and still became one of the biggest stocks in the last 20 years with just pure revenue growth until they finally monetized everything. And then it turned into be an earnings powerhouse. They didn't have earnings for many years. They put their money back into business. These are institutions that are buying right here. So what you'd like to see is a pullback to the 100 area. And, that stock's at a new high. So it's demonstrating that it's a leader in the brand new market. And that's a good place to add a position.
There's Roy, it's Dana again. Sorry.
Hey, Dana.
There's a biotech company that I've followed for a couple of years. I read their 13F filings.
Yeah.
And they're one of the top. I suspect they're buying some of this stuff because I know they own NBIX. They own 100%.
They do.
So.
Oh, they do. Okay. And, that's, a lot of the, you're seeing a great movement from many of the lower quality biotechs. And so there's going to be quite a bit of buyouts and mergers and acquisitions and things like that. If you want to take a flyer, ARKG has a lot of these names in it, and that's, of course, that's been murdered. But there's a portfolio of of biotech stocks right there. I'm trying to find the leaders, not the ones that are beaten up.
That hedge fund held the global blood therapeutics, the one that just got bought out by Pfizer.
GBT.
Yep.
Yeah. GBT. And I'll pull that up in a second. This is a Kathy Woods favorite. She continues to buy it, as the stock languishes. She had a big position in NVTA, and, she's ridden the stock from 60 to 2 and, not making money. And, companies like this will be acquired more than likely. That's probably how that will be handled. And this is the one that Dana mentioned. So this is a lower quality because you can look at the numbers. Look, they haven't made money in 10 years. They've lost money for 10 years, and finally they were bought out at a pretty significant premium. So 100% premium.
Roy, can you pull up XBI for because me personally, I'm not a biotech expert, so I can't risk that type of money in them. But the ETF is I play that.
This is I really like this, and we're looking to add it. We're looking at adding it now. It's come back above the 200-day. It's got a number of stocks here. I find this is a much better way of playing it than ARKG, and it's better because it's not the IBD, which has these larger stocks like Gilead and Amgen and Celgene, and these are, they're really laggards. You want to get the up and coming, companies, and this is definitely a way. We're looking at adding this, on a pullback as well. It's just tightening up. It's just going into a stage 2 uptrend. It just needs to get above the 200-day. So it's off the bottom, going sideways.
I would point out with this chart too that on 8-3 and 8-4 it had 2 gap ups, and hopefully those 2 gap ups are held and they're not filled. But that's a pretty big sign of strength. 2 gap ups in a row.
It is. And so, Charlie, you've got 3 big volume accumulation, and these are really, that's not really quite a pocket pivot because it's above the 10-day like that, but certainly you've got a pocket pivot right there, and followed by the 2 big gap ups that you're talking about. Well, the gap up there and gap up there.
On that first gap up, actually, I didn't realize what you just said earlier about IBB and XBI. So I should have bought XBI, but I bought IBB on the first gap up with a stop loss on the lows. But I might be looking to get XBI instead now that you said that.
Yeah. So just if you take a look. These are the larger stocks that aren't, that don't have the upside. See, Gilead's not going to double anytime soon versus the other pond that you're fishing in has, many of those stocks that can double, that can double with buyouts and things like that. To me, this looks basically like dead money,
Definitely. I agree. Yeah.
Let me see if there's any other biotechs. That's all that I had right now. Let me point out this. Now, this is too thin to buy, guys, for us, but this is turning into be a juggernaut. So look at the volume. See, it's trading 100,000 shares, a day. So it's only trading $10 million a day. It's too thin, but look at the stock making a 52-week high. Now, what's interesting, they own 33 restaurants. You can go to the site, and it looks really interesting to me. And they're going to open and look at the numbers. They're going to open another 300 restaurants. This stock is going to grow 10% per quarter for the next 5 years. So 27 million to 29 million to 31 million to 38 million to 41 million to 44 million to 48 million to 52 million. That's going to happen for over and over and over as they launch. As they launch all these new restaurants and they bring them out, across the United States. And there's the earnings breakout where it was up, 10% on the 10-300 that day. And I saw it, we just can't buy it because it's trading 190,000 shares a day. And, I'd be half the volume. But the stocks like this, I remember playing, Costco was small like this when I started playing Costco back in, I think in 91. And, companies like this, I remember Five Stores. That was a big one, the big discount retail establishment. And you can get quite a bit of leverage in terms of performance, as these stocks just have a cookie cutter approach. So guys, keep this one. And $90 stocks go to 100. And so this is the stock Wes and I were talking about buying. I have an order in to buy it at the 21-day, which is 78. I've got an order to buy it right there at 78. If the market, comes down quickly, and I've got a standing order right there at 78. Oh, this is another biotech that reported after the market today. And this is quite interesting as well. So they reported the quarter and earnings are going to be up 34% next year. You've got a downtrend there. And I'm watching to see if this stock can get above 22 tomorrow. So, before, they've had really good numbers. When you can look at this in the past, you can see 400% earnings growth, 150, 189. I haven't delved into this quarter yet, but it wasn't, so the quarter, you had a negative comparison. But if the stock is up on that, they would have said positive news in the conference call. And so they probably gave good guidance looking forward. So this would be appropriate to buy, taking out this 22 trend line tomorrow. You can see it's at 2188 after market. So this might be a candidate to buy in the biotech area as well.
That trend line carries it. If you look at the weekly chart, carries nicely as well.
Does it? Okay, let's take a look. Boy, it sure does. I mean, you can draw that trend line from
That's
there.
how, it's funny because I got the same one on my charts too. Same weekly, yeah.
Can you clue the rest of the class in? Why is the down trend line better than an up trend line?
Oh, it's just, it's showing you this is first of all, breaking a downtrend line is the point of inflection to buy. And, you want the stock then, of course, to turn into an uptrend. So breaking the downtrend is the pivot point, the point where you have the least amount of resistance, where you should be buying, taking out that resistance line. And Brad mentioned this too. Look, notice here that the stock can see it's going sideways. And on this weekly, you can really see this volatility contraction pattern, see how that tighten up. And so, undoubtedly, I might buy the stock tomorrow, depending on how it acts. But that's exactly, you're not overpaying, you're buying it, breaking the downtrend line, and it's on its way to a new 52-week high after consolidating for a year. And I think I looked, look who's in the fund. You got 743 mutual funds and managers that are, these are mutual funds that are in the stock. And you've got, of course, a blue chip one. This is one of my favorite, T. Rowe Price, New Horizons. They're in it, so they're in that IBD mutual fund index. So this is exactly the type of treasure that you can find if you look around. looks, let me point this out, guys, too, in the solar area. There's, some of these companies that have picks and shovels like this ARRY, then they reported the quarter, the stock's up 10% tomorrow. This is going to be a beneficiary of the solar industry. So they've got ground mounting systems. You've got institutional ownership here. You can see the stocks now in a stage 2 uptrend. And there's your buy point. I actually bought this stock personally on that day as well, right there. But I'm looking to, I didn't want to take this stock into the quarter either. And it's had a good reaction to the quarter so far. So we're looking at adding that in the solar area along with this one. This is another picks and shovels in the solar area. So you're in an uptrend now. You would call this an early cheat, getting with that 10 days crossing the 21-day, going above your pivot. There's your buy point. And again, coinciding with breaking the 200-day. And so this stock looks quite interesting technically, but earnings are in 6 days. So what I liked about the stock is earnings are going to be up 32% this year, 128% next year. And this is before the tax incentives. So this is obviously a smaller company at 3.8 billion, but they have, it's a small cap company that should benefit from the inflation protection package.
Hey, Roy, can you have a quick look at AEHR? Want to
Yeah.
get your opinion on that one.
So this is this company had really good numbers, and so they're in the semiconductor industry. I'm not a fan of the group right now. The group is performing poorly. NVIDIA warned today. Micron warned again the second time. They warned today again. And so this is in that area that where everyone has they've over purchased. And I think business is slow. So they had a great quarter. So the stock has had poor relative strength. Now, because the stock's gone from 6 to 16, now it's outperforming 99% of the stocks out there. So it's too extended now to buy. And but the numbers are outstanding. So the numbers are outstanding. And so it's in the testing area, and it's 1, 2, 3. Actually, David Ryan calls this ants. When you have 12 out of 15 up days, that those are some of the strongest stocks in the market. And look, this stock is going up 3, 4, 5, 6, 7, 8, 9, 10. So 2 more days, and you've got 12, and you hit that threshold. This should be definitely on your watch list. And what's it look like on the monthly? You've got some overhead resistance, but it's a small cap stock. So, if it could get up here, take out the high, and you're on your way.
I gotta say too, I think this is either does now or is gonna fit the power play or high tide flag criteria soon. So
yeah, so 7 to 14, you could you most assuredly have gotten it there. It's gone from 7 to 16, and a couple of those, if you follow the high tide flags, and this is purely a speculation. I actually bought this stock today, and not for clients, but I bought it personally. So you can see where the stock. What got me interested in the stock, you can see where the stock traded 83 million shares this day. And the stock was trading at 8, and I've never seen this happen. They priced a secondary at 1850. So they priced the secondary 100% higher than the stop price. I've never seen that happen. Normally the stop price, the secondary is priced less than the stop price is currently trading at. but they actually priced it at $18.50. You didn't have, so there's your high tight flag, your power play. And you can see that, I bought it today, just rounding out and turning up. And, this is pure, this is for fun. This is for fun, not, it's just a speculative high tight flag power play. And there's the place you add, taking out 23. So, I'm watching this closely to see, many times you get these power plays like this and they double quickly from periods like this. But look, it's tiny. See, they have no numbers. It's just purely a biotech momentum type stock that you could never, you couldn't put your mom's money in something like this, but you could put your money in it, I suppose. Another high tight flag was that I noticed was this BMEA. I know Mark Ritchie's watching this. So another high tight flag, and he's made a lot of money on these high tight flags, but they just don't have any numbers.
It's kind of interesting because you see there's actually a fair amount of others as well, like RYTM.
Oh yeah,
and BEAM. It's weird because you see these biotechs setting up, but we're in the middle of a bear market. How are they pushing up so high so fast?
And that's what happens when you have new leadership, Charlie. And but these also run out of gas too quickly because they're going to bust. You play them on the upside on the momentum. You see, I actually bought this stock right there, taking that out 1, 2, 3, 4, 5, 6, 7 days ago. I bought it right there. And I turned around and sold it. I think I sold it a couple of days ago. And this is a perfect example what I think Dana was talking about, buying the breakout, sell half and backstop the rest. That's a pretty decent strategy, but that's a great strategy. But I just sold my entire position in it. Just for InMode had a good quarter and they raised guidance. And some of these stocks that have gotten hammered, that when they finally raise guidance, I see some institutional ownership here in InMode. That's the cosmetic. This is what Shockwave is to cosmetic procedures in InMode's product. You see. Oh, this is a strong group, and I'll pull these up. So you've got the telecom infrastructure group, and these are the leaders. So Dycom, I'm watching, we'll probably add this stock. Wes and I were talking about this. We'll probably add this stock to the portfolios, and I'll add it personally as well. I'm waiting to see if it comes back to the 21-day. Earnings are out September 1st. You can see that reversal day at the 10-day. And you have to be careful because look how you got shaken out here. Where if you bought this stock anytime when it firmed up, if you're looking for an early entry, and say you bought that breaking that down trend line right there, if you bought it right there, then you got stopped out right there. It's very, Minervini calls this like a Hardaway crossover, when you get stopped out and you come back and you make new highs. And looking back, that's how shakeouts form. So you got a shakeout, it's in 52-week highs, it's the stock's acting great, and the numbers are really good. The numbers are excellent. 20% revenue growth. The quarter was 900%. 2023 earnings are going to be up 147%. 2024 53, and so it's in the telecom build out area, and you got some confirmation with a couple of names.
It's a low volume stock though.
It is, but it's trading, okay, 20 million. So it meets our criteria of $20 million. It is, it is a low volume stock, and the market cap's only 3 billion too. So, it's a smaller company, but you do have 468 funds that are in there buying, and you also have some confirmation. So this is another stock in the group. And actually, I saw someone mention something on earlier on chat box. I'll pull that up. So this is really got great action. So earnings are out of the way. Revenues are up 30%. Earnings are up 80%. Earnings are going to be up 111% next year. The breakout on earnings, there's your 10-300 day that I'm looking for new leadership at a 52-week high coming in. And we're very interested in buying the stock coming into the 10-day, if that happens. And the 10-day tomorrow is 31.20. So, we're looking at buying that, coming in, breaking out to a 52-week high. This has got a lot of things that we're looking for. All-time highs. Look at that. And this stock essentially didn't do anything. This stock hadn't done anything for 15 years. Now it's just going. So, what's the old saying? The bigger the base, the more the move, the higher the space. So so you've got confirmation in this group, and this is another one that's in the group, CLFD, telecom fiber optics, and look at the accumulation going on. So, higher than normal volume. Stocks only, it's $1 billion company. This is a tiny company as well that's in growth mode. You've got fund sponsorship in there, COFD. So this is where leadership, this is where you want to focus. You don't want to focus on Zoom and Teladoc and all that, all those old leaders, and Twilio and Roblox and Unity. Coinbase. You don't want to buy any of those stocks. These are the stocks that can double or triple.
So Roy, far as entry, you'd have to wait for a pullback before you start a new position at this point?
Yes.
Okay.
Yeah, I'd like to see it come into the 10-day. I'm not going to buy this stock extended from the 10-day at all, period.
Yeah.
And so the 10 days, see, if we have an 8% stop, if we bought this stock and it hits the 10-day was a normal reaction, that'd be down 12%. Just normal reaction. And so the decision to make then is, do you buy half of the 10-day and half of the 21-day if you scale into it? And, here you can see the breakout at 69, and this is so extended, but if it just comes into the 100, that's 13%. You can see if it'll come back to 100 and build a base, that would give you an opportunity. You can't take your eyes off of these. See, the ones that I'm pointing out, they're not setting up right now, but you need a screens, so that you can have them right in front of you and watch them. We also own this company, Evolent Health. Really good numbers. Broke out, but they're doing a secondary right now. So the secondary, I don't think it's been priced yet. And we're in this stock. Really good numbers. Earnings were up 600%, 900%, 167, 38 and 44% revenue growth. An excellent quarter, good guidance. They're going to hit the numbers. So, if the market cooperates and this stock cooperates right here, we'll be adding to this one. So that's what you want to see. And when you also want to look, pay attention to the weekly and monthlies. See, this is a stock that's a 6-year breakout. And for people that follow the life cycle trade with Kathy Donnelly and Eve Bobick and Eric Kroll and those guys, this is a stock going through the due diligence. Now it's really in the advanced phase from that bottom. And it's, now this is major. It's cleared 6 years of resistance. And so with the numbers that these guys are doing, market cap's only 3 billion. So we own this stock as well.
Roy, how did you get in this one? Because I remember last month we talked about that tight pivot, and then it kind of just fell right back from 35 all the way back to 30. So you must have got in after.
Yeah, got in after because we would have been stopped out. And somehow coming back on the right side of this base, we bought it back. We bought it back like 2 weeks ago. We bought it for the first time 2 weeks ago. Let me just venture to say that it was probably right around here.
Yeah, right at that pivot. Okay.
Yeah, right at that 32 area.
Got it.
And so that looks like exactly where we bought it. 32 and see the old high over there at 33.14.
Right.
So we bought it like right there at that pivot.
Okay.
You think of lithium stocks, Roy, ALB, LT, HM stuff. They're pretty wild, but
we actually in that March we tried this here. I think we bought this. We bought this stock. This was early, so this was like 3 months ago. So either the stock wasn't ready, or the market wasn't ready, or both. But we actually bought Albemarle and lithium, both of these. We liked the idea that you had more than one stock, confirming the industry move. We felt like as the move going to EV would impact lithium. Come to find out, though, there's not a glut, or there's not an undersupply in lithium. Apparently there's plenty of it. And so, the stock just sold off. So we actually, I know we bought the stock here and probably sold it right there on the drop. And same thing with Albemarle, ALB. And Albemarle gave terrific, this is, right here, look, they gave terrific.
Strong guidance, yeah.
They gave great guidance.
Yeah.
And so it had, it had the ingredients. Look, it traded 3.7 million shares. Stock was up almost 10%, almost 300%. And we bought this stock somewhere in, we bought this stock somewhere in here and got stopped out. We stopped out of this one right there as well. So it was starting to move. You had that guidance, you had great numbers. And we thought that it was coming. We thought that it was going to be like solar. Solar's coming out of the box now with the biotech, so you can see the leadership. And it was a fake out, and you get a lot of that. So, you've got to be prepared to take your, 10% loss and move on, because you certainly can't ride it down from 273 to 189 and hope that it comes back.
No.
Let me see if there's, in this area, when we actually tried this too in the LNG area. We didn't buy this one, but we're looking at buying this one. So they reported the quarter, and look at the earnings. Earnings were up 300%. And revenues were up 165%. Now, so this is the company that said they're in Louisiana, in the Sabine Pass. I actually worked out of this area when I worked offshore when I was going through college. And what they do is they simply, the natural gas is simply pumped to their stations. They convert it to liquefied natural gas. To Exxon, to Conoco, to whoever, and then they ship it out. And there's as you're all aware, I'm sure, natural gas here is, I think, $8 BTU, and it's like 60 in Europe. So they're signing contracts like FLNG signed I think they signed a 23-year contract to provide liquefied natural gas for some of their clients. And this is certainly firming up right here. And so this looks very interesting as well. So this natural gas theme, I don't think it's over. You know, it's setting up very well. So FLNG's in the group, LNG's the leader, NFE, they're actually in this area along with the solar area as well. So they've got, they can go to Europe and convert the facilities so that they can accept the liquefied natural gas. So you can see this stock breaking out the pivot. We're very interested. And we actually bought this stock too, breaking the downtrend line. See back in here and got stopped out earlier. And, you know, gave up on the trade, and the trade, it's come all the way back. So now, you know, we talk about the second mouse gets the cheese. You know, the first mouse right here that bought it 52.37, that was me. You know, we got caught in the trap. And then the second mouse is getting the cheese. See, it's all clear now for the second mouse. So this is the old second mouse setup. Second mouse gets the cheese set up right here.
Right.
Boy. This is a fascinating business.
It is.
Hey, Roy, I see where retail's been pretty strong, like MUSA and even CASY looks pretty good.
But this really looks good. It doesn't fit my profile, so it's in the convenience store area. I don't know if they're convenience stores or what, but certainly this, you know, the stock looks great.
Yeah, we got a few of those around Charlotte, man. You should know that.
We do Murphy USA.
Yeah, they're usually at like a Walmart or something like that, you know.
Well, I
Walmart
shop.
parking lot, but it's a gas station out front.
Okay, I do all my shopping at Amazon, Thomas. except fuel. And who's the other group that's setting up? And look, see, this is I don't want to be in the defensive area, so this is really a defensive area. Perhaps they're making, you know, because fuel was so high, you know, maybe their margins were expanding, and now maybe you can make the case that you've got peak margins. And actually, we'll pull up energy here because that's what you've got to be careful that you've got peak numbers in energy. And I'll show you how the market rotates out of the top performing groups to just you know, rotational action that, you know, takes place that you have to be aware of so you don't get trapped. Tom, who's the other one?
It was CASY.
Oh, KC.
Yeah, their chart didn't look great, but the numbers look pretty good.
Numbers look great. And Wes and I were trying to determine, and I've recently had a position in Ollie's, and we were thinking about adding Ollie's, but, you know, Walmart blew up because of inventory and, you know, an excess supply of inventory, and Target blew up because of their inventories, and they, you know, guided lower. And so we were, and we don't know how these are going to be impacted, you know, again, like Ollie. And of course, this is a little different of a store, but this stock pulled back, see, to the 50-day, bounced off the 10-week 50-day. And we were, you know, we're not sure if these guys are beneficiaries of all that inventory that they can buy and resell, or, you know, or if it's going to be, you know, or, you know, with the consumer pulling in its horns, will a stock get hit?
But Dollar General and Dollar Tree are both setting up too. So maybe it is the lower cost providers pick up.
And it might be. And this is what I was afraid of. See, I knew that the consumer was having trouble, you know, and I think I got a note the other day that I think credit card debt has expanded to, I forget how many billions of dollars, like in the last few months, you know, credit card debt. And, you know, the consumers not buying as much. And then you have inflation in terms of food. And that's really hurt. That really hurt Walmart primarily because they're the largest grocer in the country. And, you know, they weren't able to pass through the cost increases. And so, you know, this stock got hit when Target and Walmart both reported, but it has come all the way back. So it is showing you, you know, this type of action. We are considering this. Earnings are in 16 days. We're not going to get it with the drop that happened here. We're not going to get in front of this number when earnings are in 2 weeks. But, you know, there's Dollar General and who's the other in the group?
Dollar Tree.
Yeah, DLTR.
I got
So the
knocked out.
same, yeah, you have this one.
No, I got knocked out of it. I tried to buy it earlier in the curve and
Yeah, so and there, you know, there it is that
right there,
you got kicked out right there. And that's, I mean, it was setting up beautifully. There's the break of the downtrend line. And if I'm in it, I would have sold it right there as well. You know, you don't, particularly after this break, you know, after the big break, but it is setting up, but earnings are, you know, in a couple of weeks. But, you know, the group is strong and, you know, maybe Dollar Tree and Dollar General have figured it out, you know, perhaps.
Roy, what do you think of the aerospace defense sector? It seems to be perky, seems to be HXL ticker. Seems to be, it's got a blue dot on the RS.
You know, you know, this month, you know, Boeing, you know, I don't know if they've got a contract with Boeing, Brad, but this is setting up quite nicely. So, you know, remember in a new bull market, it's going to last a couple of years. So this is just setting up, coming out here. And let me see, what does it look like weekly? I mean, it's, you know, there's the break, it's setting up, it's above, you know, there's your pivots. It's setting up quite nicely. Look at the move there from 2008 to 2018. I mean, that's pretty picture perfect. It really, you know, right there. And you get through that and then really game on because that's a 2-year breakout.
It's got great fundamentals actually as well.
But those fundamentals are really, I was looking at this earlier. I was looking at this, comparing this to NOC, which has pretty good action, but the numbers aren't any good. And I mean, this is definitely on my watch list, Brad. I mean, great numbers, 300% growth.
Howmet is another one that's a good one. Howmet.
Who's that?
Howmet. It's Howmet. I think it's HW. Geez,
I saw. Is it
Howmet?
Is that HOW? HEIC?
HOW. Yeah.
HOW.
And then right there at the bottom. Yeah, there you go.
And you know what, Brad, what I like is, see, I mean, you do have some good numbers here, you know, and you see you have confirmation in an industry group. And I mean, the industry group's not great, but those, I mean, obviously it's moving up right now.
Yeah.
So, it's moving up and, it's setting up, for sure. When you get a move like this, you just have to let these stocks rest and breathe a little bit. If the real move, you got plenty of time for this to go sideways, come in, and then take out all these pivots. So look at that great action down here. I mean, we follow the volume. The volume tells you everything. If Fidelity is buying something, we're just We want to buy what Fidelity's buying because they're buying billions of dollars, of the stock. So this is a really interesting group. HOWM. What was the other symbol, Brad, that we just looked at? What was that?
It was HXL.
Yeah.
Yeah, that was an aerospace.
And I was looking at NOC, and this has been on our watch list forever, but the numbers aren't good. But the action, so if this Ukraine-Russia situation further escalates, then there's just going to be a pile of weapons that are going to be sold to the EU and other countries. And so, and which could last a long, long time. I guess that's why the group is here. It's a 33, aerospace defense number 33. But, the stocks have decidedly indecisive action. Based on the numbers here, the numbers aren't explosive, and maybe that's just holding the stock back. This is probably when the invasion took place. See right here, there, and there.
Yeah.
That's when the invasion took place.
Roy, this stock has hit resistance 3 times. And we're at resistance now. It's hit resistance and come back to support.
Yes.
So,
when it finally punches through, I think it might punch through with some.
Well, I definitely would wait and see if it does punch through.
Yeah.
Otherwise,
Yeah, that's a good. Yeah, I would not buy the pullback here. I'd buy the breakout.
Yeah.
At 4. I'd buy the breakout right there at 488, 488, right there, and then have your stop in and let her go. I wouldn't buy the pullback because it's so wide and loose, I guess is how you would describe the pattern.
Right. I
it's
agree.
been going
Roy.
back to support every time. Well, the last 2 times it went back to support.
It seems to trade in a box, but if you go back to, I don't know, look at around January, February, March, and then it had a breakout, it seems to like to trade sideways and then break out and trade sideways again. So it's an interesting chart that way. It behaves a lot. If you go back far enough, you could see it was in a range, and then the breakout was a pretty nice little pop. But you have to kind of be patient and play that way.
And notice this is the kind of environment you've been in where I've told you, you got a 3-day pop. If you happen to buy it, in it reversed, you got a 3-day pop. You got a 3-day pop. You got a 2-day pop. You got a couple of days, a couple of days pop. That's the environment that the market is traded in for many stocks so far. I wanted to point out too, AstraZeneca, this stock is setting up pretty nicely as well. Earnings were out of the way, and you can see the stocks, sitting here. I'm waiting for the next move, but earnings were up 110%. And these are the types of biotech stocks and medical companies that that are attractive to me. 186. You're not going to double your money in something like this, but it can break out and go up 20% for you. $186 billion market cap, but earnings are out of the way. It's setting up. It's trying there. So if it can get through that pivot there, it could be game on for this one. And you're looking for this move. See where it broke out before, 62 to 72. That's the trade that you're talking about making. If it can break out at 68 and go to 78 to 80.
Hey, Roy, before we end the call tonight, could we talk a little bit about the upcoming CPI in the morning?
Yeah, we had mentioned that, the estimate, I don't know what the estimate is. It was 9.1% last time. We're looking, we think it'll be in the mid 8s, probably 8, it'll probably be like 8.5, 8.6.
Yeah, I think that's what the forecast is.
And I don't know how the market's going to react. We'll just see if the market reacts, positively or not. And, it could, if it's viewed favorably, if it's a friendly number, that means it would be less than expected. The markets can probably rally on that. And then you got PPI tomorrow. You'll get the second dose of that. And we just still think that we're trapped, in this bear market rally right now, because there aren't many stocks to buy.
And yeah, I'm looking at the MACD on a lot of stocks, and it's hot. And so I'm anticipating pullback.
Yeah, let me actually, thank you. Let me pull that up. Let me share my screen and look at the MACD, new share on my platform.
I look at it on a 6-month, but everybody have their own preference on how they interpret it.
Right. Okay, let me pull this up. Oops. And let me get this here, new share. Are you guys looking at the Qs right now on this chart?
Yep.
Okay, I want to make sure this is a system I use. It's called AIQ Systems. And it's actually it's got some artificial intelligence attributes, and I just erased it. Are you still looking at it? You should be looking at the Qs right now.
Yep, it's working.
Okay, so this is what's got our attention, and because I think it was Cassandra.
Yes.
And so here's the MACD. So we're looking at the technical aspects. Look at when the MACD peaked, and a sell signal is when the green line goes through the index line, the price phase line, and so you can see after somewhat of a nice uptrend. Then the MACD turned over and you got a sell signal, and then that led to the further downtrend. And see, this is what we're afraid of. See, where this MACD has come quite a bit, and it looks like it's poised to turn down right here. So I think, and this is how tricky it may get. Back here at the April top, you had a big day off the 10-day, and see the market was up. The Qs were up 2%, and then you rolled over, and I think this is when the PPI came out. I think the CPI was this day, and the PPI was that day. I think. Don't.
What day is that?
That is April 4th and April 5th.
Okay, let me check it.
What is that? What day is that on the calendar?
April 4th is a
Yes.
Monday, and April 5th is a Tuesday.
Okay, then it was not. So it was because it would have come out on a Wednesday. And anyway, the MACD rolled over right there. You got to rally back up, and then it failed the next day. So you have to be, so we're not going to necessarily, if the market's up big tomorrow, we're not going to necessarily cover, until we take out yesterday's high, because you could have a fake out. And we're going to be watching this carefully to see, how the rally unfolds, how the sell-off unfolds. But we're due to pause here based on the technicals. And another technical indicator that I look at, it's one component of the MACD. It's called the price phase. And yep. So look at this.
Yeah, I look at that too.
Okay, so here's the move from the bottom to the top. And this is an early signal. So this is going to when it turns, when you have a lower high, this is going to give you an earlier signal than the MACD in fact does. So you got a sell signal that day. See it, the 10-day right there on the price phase, and then look subsequently what happened. You went down for weeks, went down for weeks before you finally bottom, the ultimate bottom on the price phase, and then you turned back down. And look, today was the first down day. See, this is why we're also very cautious. So you got the first sell on the price phase today. See, you have a lower high. So this indicator is telling you, and I'm interested in watching this because the market can be up, but this can make a lower high tomorrow, which would be a confirming sell signal. So I'm watching that to see, what happens, there.
What's the name of that indicator, Roy? That last one?
The last one is the price phase.
Price.
But do you have where it had its prior bottom? Do you have possibly divergence there between the indicator and price?
Where are you looking at from here?
The last two big bottoms in price and the last two big bottoms in the indicator you had up earlier. You just switched now.
Okay, this one.
Yeah, it looks like you have divergence between price and your indicator, which could be an indication of a possible reversal. Or at least that's one of the ways I use MACD.
And tell me,
no matter what the element is.
John, point out the day that you want. Let's go to the day that you're talking about first.
I can't make out the day. Hang on, let me see if I can switch my screen around.
Well, I think he's talking about mid-May and mid-June.
Yeah, mid-May, mid-June. Those.
Yeah, look at the last two bottoms in price, Roy.
Yeah.
That are like the lowest low and one to the left.
Yeah.
Whatever days those are, the bottoms of your indicators are going up compared to price, which is going down.
Oh yeah, you're right. You're exactly right.
Divergence.
Yeah, exactly. Yeah, you're right. Now notice here there was no divergence with price. It went, it went straight up and it's straight up. And here you had a divergence that day.
Yeah.
Where you had you had a higher low that day. Then, and sometimes it gets tricky. That's why a lot of these indicators are just tools in the toolkit. And there's a divergence. See right there. See, look at that. See right there. And I actually bought this day personally. And this was one of the worst days that I have had in the market because, and I forget what the significance of May 4th, that could have been a Fed day or when Powell spoke. And so there it is. So the price phase turned up and then, and I was very long, I think in the queues and took a big whooping this day here. And looking for the trade and it stopped out immediately. Stopped out immediately in one day, and then the trend resumed, and that's how tricky it's been. Then you up here again at the market bottom, you've got a follow through day right here.
Mm-hmm.
You had two consecutive follow through days in the NASDAQ to potentially tell you that the market bottom is in.
So on June the 17th, my MACD indicator triggered a divergence between the prior lowest low of price and the prior lowest low of MACD. And you could see if you drew a line between those two huge bumps, they'd be going up and price would be going down. That is oftentimes a leading indicator to a potential reversal. And what's interesting is a lot of charts look like exactly like the one you're putting up, which is MACD does look frothy. There's a trend line it's got to break. There's a moving average it's got to break. So there's a lot of resistance ahead, but it's just about as clear as Mississippi mud on what to do with that.
Yeah. Yep. And again, it's going, I mean, tomorrow is going to be a pivotal day, I believe. And it's going to be, I tell you, if it's a bad day, it's going to be so easy to just sit out and let things unfold. And how it gets tricky, it's the FOMO part where, we're obviously in a short-term uptrend. You got you got higher lows, and there's your trend line on the downside. But that would give you that would sort of reset the bar if we come down here and break the 50 and you come down here to the trend line. If that happens, that's going to give you opportunities on all these leading stocks that we've talked about, because it's going to be almost impossible for the biotechs to hold in here and not have a 10% pullback. If the market rolls over, if the big stocks roll over, right here.
Yeah, looks like the Qs are at support, right now.
They're at the 10-day.
Well, I have I tell you what has saved me, and I have learned support and resistance. I draw the lines and they work. They work like 95% of the time. And the Qs are at support right now, and it just broke through one support and has another support. And if it breaks through the next support, which is around, what is this, around 314.50, then I think it's going down.
And you can see, I look at it from the standpoint, this is a longer term view. This is quite instructive too, when you go back and you look at prior bear markets, prior bull and bear markets. This is the 30-week. So this is the 150-day, that Stan Weinstein wrote about in Secrets of Profiting in Bull and Bear Markets. And I was a big subscriber of his in the 80s. He had a publication called The Professional Tape Reader, and the top of it was The Tape Tells All. And so this is something that kept me out of the 2020 bear market, and it's helped me survive the 2007 to 2009 bear market. And it's simply looking at the 30-week. And a 2-week close below the 30-week, for me, if you're not already out, you must be out when that happens. And you can see again, and if we have 2 straight weeks above the 30 weeks, so we're right there at it, then I will get increasingly bullish, because the trend, I'm following the trend, and you can't ignore the trend. And so we're at a pivotal point. Look at in March and April, where we bounced up right to the 30-week. We couldn't close above it. And here you've got the same type of move down. So it's an obvious inflection point here. And looking at this, noticing what's happened in the past, it would be nonsensical to have a lot of exposure. You want to let the market prove itself. You want to let the market prove itself here.
Yeah, I totally agree. It's at a genuine crossroads, stacked to the downside a little bit, but it's at a crossroads, and it could go up and it might not.
Yeah. And, for people that want certainty, many times you just don't have certainty. And that's where we are here. I'd love to be 200% long. I can't wait to get long. I can't wait to, for many more stocks to set up and get as long as I possibly can get, and make a lot of money for my clients and me personally as well. But this is where we are. It's a treacherous environment. And I don't want if the next leg down comes and the economy collapses and so forth. Remember, in 2007 to 2009, it just got worse and worse and worse. Let me change the date. See if this gets everything. Yeah. So this is the 2007. And this is what kept me from getting destroyed in 2000, back in 2007. So this was 15 years ago. And so you had the break of the 30-week. Notice the uptrend there. See, this in 2007 was my second biggest year. 2007, when you're above the 30-week the whole year. And if you take a look, Google had a massive move in 2007. And I had a huge position in Google, and this was a $1 million year for me just in Google itself. And I got kicked out. Notice 2 weeks below the 30-week. And notice, see, this is what kills you in terms of your patience and having persistence, is look how long you're out of the market. If you're until the indicator turns up. And notice here you still have a declining 30-week, which isn't obvious. I mean, which is not good. And so you got the move back up, the move back below it, and then again using that 2 week. That's just telling you the trend. The trend is you've got to follow the trend, not the narrative, not what not what you think the Fed's going to do, not what the government's going to do, not the election, not who's going to be the new president. It's the trend. And I missed this entire move down I just remember, and the downtrend was so brutal, but this is what I'm afraid might happen. Stuff got worse and worse. See, remember you had this big rally to July. You rode over, made a lower high, and then the real estate crisis got worse and worse and worse. And look, people were saying it's over. You'd had a big bear market already. You were down 30% already, and then there was that next leg that that put people in the fetal position. So, see, look how long these bottoms take. So you got to be prepared that we're not near this thing being over. If the inflation news is more persistent and the Fed has to raise rates higher while companies are doing worse, at some point it's going to flip-flop, and you're not going to pay 27 multiple on Apple that's growing at 2% or 5%, and then that's when reality hits Wall Street. And because of valuation metrics, everybody lowers their estimates. And then we're in that recession in the first 2 quarters of 2023, 2023. So, that's what I'm prepared for. And again, if we had opportunities, I'm showing you the best of the breed, and it's just a handful. We're in a good bull market. There's so many stocks, you don't know what to buy. And this is not the situation. There are a lot of people just like me that are focused on the same names because this is the only thing that you see that's worthwhile to buy. Now, this could be a self-fulfilling prophecy as well. Like if, we could be pushing these stocks up, the Jim Ropels of the world, and, the T. Rowe Prices of the world, and the Fidelities of the world, because everybody's got to have them in their portfolio. You got to have those stocks if you're a growth manager in your portfolio. And so you can look, this 30-week, I think, is really important. And then again, let's take a look at this on 2000 to 2002. And look at this, where you're below the 30-week. Remember, 2 weeks below. This is how I stayed solvent too in 2000. And I put this indicator in after I had to put I guess guardrails on to like what forces me out. Like, what forces me out if I'm following the trend. I can't buy 2 weeks below a break 2 weeks below the 30-week. And this is what, this is a generational type of move. And there's the legs down, the move back up again, the break again, and so forth. And you've got plenty of time. Now, if we don't know what this is going to turn into, this is a, so far it's a bear market that we typically see, but it's nothing great. But in a recession, again, you typically go 10% lower. And, and that takes time. This takes time for the fundamentals to deteriorate. So the fundamentals, like Wes said earlier, employment's a lagging indicator. It takes a while before the fundamentals deteriorate. So that's a little, that's a tool from the playbook. John, thank you for that. And okay, we're back here. Oh, let me pull this up, guys. Well, I'll show you another stock that this is the last stock that we're in. PRVA. So this has been a pretty decent winner. You can see it broke the resistance right there. So it's a healthcare stock that helps doctors be more efficient with their patients. It was a recent IPO. Really good, solid numbers, growing at 30%, really solid numbers. And you can see the stock bottomed. Now the stock's starting the advanced phase. It's over the 200-day. It was an IPO. And I'm not sure where we bought it, probably right in, I'd say probably right in here, somewhere around the 33 area, somewhere like that. And now earnings are in 2 days, and we do have a profit going into the number. We'll probably hold this stock going into the number, and we've been lucky so far. We haven't been blown up in anything, but we only have a 2% position here, so we're going to carry it. If it reacts great to the number, we'll get more. We'll get more exposed. And favorites. And I've gone through so many screens, well, today even, and just over and over and over. The more that you screen, it doesn't provide you with any more opportunities. This is the market growth 250. So there are 284 names here. And notice, and if you have one screen or list to trade off of, this is of course with MarketSmith, and Mike Webster actually designed these screens for the MarketSmith Growth 250. It's comprised of over 30 different screens. All the screens have different metrics, and it's like the FFTY. It's just based on math. And you can see, and you want to concentrate, and you can see who the leading groups are. You want to concentrate most of your buying in the top, in a bull market, the top 4 or 5. But, typically, O'Neill said the top 40, groups. But you want to narrow that down and have the leader in each of the area. That's why, Solar Edge is not the leader. Solar Edge is the second. That's the the number 2 in the group. And they missed their earnings estimate. The stock got trashed while Enphase went higher. So you want to identify the leaders, and you can see that I like this NOVA. So that's in the solar area. There's that SHLS that I mentioned. DQ has great numbers, but they're Chinese, and that's a little bit iffy. There's Casey, there's Murphy. So, the retail supermarkets, but this is a defensive area. So it doesn't really have my attention. You know, that's like Kellogg and General Mills and Post. You know, it's a defensive area, but this is where you've got solar clearly leading. Then you've got medical, biomedical, and you can look and see how this is advanced. This group has advanced over the last 90 days. I mean, from the bottom, this has had a powerful move up. And this is what, you know, these are the names that I've mentioned to you before. There's Vertex Pharmaceuticals, there's EXEL, there's IONS, there's SRPT, there's Rhythm, there's PTCT. So there's that AONY. And then you get to the next group. You don't, skip food, wholesale food. You don't want to buy foods. Consumer education, that's okay. Consulting. There's telecom infrastructure. This is where that DY is in CLFD. That's where that's located. And there's Shockwave. See, their own, IBD does much of the work for you. You're going to get some of these true market leaders if you just stick to, if you just stick to it, if you're persistent. And, this is the time to do your homework. So we own this PRVA, we own this EVH, and that's sort of, they're setting up for you. And, they're, rotating, and, we're just looking for the leader, looking for the leadership. There's Ollie's, there's Dollar General. So this is a great watch list, if you will. There's the telecom that I talked about. TMUS has got a great chart. Who of you out there, who of you are using Market Smith and are familiar with the product?
I'm using it. This is Charlie.
Okay.
I use it somewhat. The screen that you have, the Market Smith Growth 250, is
Yes.
that
That's their screen.
that's their screen? Because I don't see it.
Yeah, it's over, it's under, I've got it.
That's one of their prepared screen lists, right?
Yeah,
Yes, it
'cause
is.
I'm in screens and I see.
Oh, no, so it's, okay, it's
Gotcha.
different from screens. It's gonna be under list, Cassandra.
Oh,
Yeah,
And so
it's a canned list that they maintain.
it is. And see, here it is under reports. See, this is under my list. So see, notice I have.
okay, I found
Yes.
it.
Okay,
I see it.
reports, Market Smith. And I always look, as a shortcut, guys, I look at, and I'll show you some of my screens as well. But you have open stock ideas. This is a neat shortcut. And you can see stocks breaking out today. And see, there's that FLNG that I mentioned earlier. There's Brown and Brown. And I look at these all the time, near pivots. So this is within 5% below their pivot. You've got 30 stocks there. I look at this, I look at this every day. I look at stocks breaking out, recent breakouts, breakaway gaps.
Minervini trend templates are quite well.
So there's Minervini, and there's the shortcut for Market Smith Growth 250. There's the IBD 50, and here's the Minervini trend template.
Yeah.
And so this is a great list. We use all three of these. And I mean, you have the screens. If you have this technology, this is and you use the technology appropriately, you're going to get some of these big winners. So Minervini's got Minervini's got a trend template, and the definition is in his book, and it has to do with the stop, with the 150 day, with the 21 day being over the 50, the 50 over the 150, the 150 above the 200. You got to have it's got to be above the 200 day. It's got to be 25% within a 52-week high. The 200 day has got to turn up. And this is, and the way that the criteria is, this is where the 200 day is turned up 1 month. Then he's got this 1 to 4 months. So the 200-day, this is where, if you want to fish in the stage 2 uptrends after the market has been in a bear market, that you can buy these stocks because you're going to have major new leadership that can take place. You know, it can be some of these IPOs that have gotten blasted that have numbers. It can be some of those. They just need time to set up. And so the Minervini trend template, he's got one from 1 to 4 months, 5 months, and then 5 months wide, and he's got a different relative strength criteria. The relative strength on this, on the top 5 months, it's got to be 70, and there's no relative strength exception on 5 months wide. But these are all lists that we look at. But the trend template's great. David Ryan uses this 1 month, by the way. Like if you're looking for stuff that just right off the bottom, and you can see, let's see how many. See, you only have 46 items that fit this criteria. And so a lot of these might be power plays where stocks, they go up 100% off the bottom, and it's been just a month since they've been off, since the 200-day turned up. And you just need to get comfortable with a way that you can find that to identify the winners. But I'm looking at earnings growth, revenue growth. It's the new high list. That's your best list. And again, the relative strength list, where the relative strength stock is making a new high. That would be your number one list to go to. See where I have them. See, I have all kinds of lists. So here's the relative strength line making a new high. There's the relative strength line blue dot list. And if you do screen these, you're going to get, there's a relative strength line making a new high. Look, that NFE that we talked about earlier, there's that rhythm that someone brought up with the power play. There's that FLNG. There's the buyout on GBT. There's the LNTH that I mentioned that we're looking to get back in. See, this is where, the Sierra Wireless was a buyout. But this is, you want to be looking at this. You want to be paying attention to this list. There's the Shockwave Medical and relative straight line blue dot. So I look at these lists every single day to try to identify something that I'm missing. And most of the stuff, you'll miss the stuff unless you have ways to screen with powerful volume breakouts and stocks making new highs, stocks holding up. And this is where you need to focus all your attention to. Again, you only need one stock and have all your money there to double your account, right? And that stock go up 100%. And obviously, because of risk, many times that would not make sense. But even where I am today, I'll put 20% in a position because I want it to move the needle. And we're trying to get, again, 5 to 10% in our clients' accounts. All you need is 10 to 15 stocks, and you have 2 or 3 of them that double, and there's your 30% for the year. And everything else can break even, everything, and you're still up 30%. But you've got to have, that's not going to happen unless we're in a new bull market. You can do it that way. Wait till it's an easy dollar environment and then concentrate, be patient, or you can chip away if you're just a short-term trader and you just chip away. You can chip away. And if you have an edge, you just need to turn that edge over as many times as you can. What else, guys? Is there anything that what are you guys doing that are successful that you're having success with today? Or is it a difficult market, just too difficult to trade?
I haven't been able to find any success. If you type in ALT,
Yeah, that blew up, didn't it?
yeah, it set up a little high type flag VCP, put it off the pullback buy off the 21-day. I tried that, nothing happened, and I tried ESLT, which is it's a defensive stock, aerospace. That's working a little bit, but
yeah,
I haven't really got got positioned in any leaders, and it's still a grind.
These are just slow movers, and I know Mark owns that, and he's been stopped out, like he was stopped out of AVD today. There's been a lot of this action in the market, stuff that's setting up and then out of the blue, boom. There's, I was looking at this NVO before it blew up, 4 days ago. Look at that. It had a great VCP pattern set up, and then earnings came out and it got blasted. ARIS was at 52-week high, got blasted. So that is, there's been a lot of that. And then, and then the stocks, and that's the environment that they're in. Just because these stocks are down as well. See, there's TAS that was down 24% after being down 70%. It's down now another 24% on the earnings move.
Yeah, and that's why I'm kind of surprised. You got positioned pretty well in the leaders. I mean, maybe not as big as you'd want, but you at least have a position. A lot of the U.S. investing champions and other people I follow just to learn from them, a lot of them haven't got any great position in them at all.
One thing I do, one thing I have learned when I have a stock that I'm looking at and I'm not really familiar with it, I just make sure it has 2 higher highs above the 30-day moving average. And that, and it typically, you may not double, but the stock it's an uptrend. That's the indicator that it is an uptrend.
Do you have an example? Do you have an example, Cassandra?
I guess you can go to pretty much any stock. I'm looking at this one you were doing at the IBD. If you're above the 30-day moving average, it has a higher high, then it has a lower low. And then looked like it was going up to a second higher high, but then today it just plummeted and just went down.
Yeah.
So,
and that was, that was the earnings risk. So that's, I mean, I think that I've got the leaders, and I want to get heavy in them, but I'm also, I don't have much conviction. So, I realize that, okay, if
give me any stock number, any stock ticker.
IBM.
Yeah. Okay. Okay. Well, IBM is below the 30-day moving average. And so you got to be very careful with that. And from the bottom, it was at support, it went up to resistance, and then it came back. So if it goes back up past this resistance of 134 and make another higher high, and then it comes back down again, when it comes back down, that's when I would buy.
That if you look at this 10-day and 21-day crossover, that tells you that from our perspective, that tells you if the stock goes from a downtrend, notice the downtrend here in October, November, to an uptrend. And there's the nice trade where the 10 days above the 21-day, and you get that trade. And we haven't had an environment where we've had a move like this that's lasted a couple of months, where these stocks move up. But this 10-day crossing the 21-day, and I use that, and that's going to also, Minervini's you're going to see that as that's going to provide you an early cheat into a lot of stocks. You don't need, if all possible, you want to buy before the breakout. Because for the last 2 years, breakouts, first of all, they failed. And you want to get in there a little bit earlier. So you need to be looking at the stocks earlier before the breakout, but the trend is still turned, so they can consolidate. The trend can turn, but they're setting up. But that 10-day over the 21-day, and they're pretty accurate calls. When you have a major downturn and a major upturn, you're going to get the majority of the move for the trade.
Roy, when you got into Enphase, you bought it just before the earnings. Just curious as to how you built conviction. I know the chart looked fantastic, but at that point with that little handle there and declining volume, but just to get into before the earnings, did you have any kind of risk? Like, did you feel a little bit nervous before buying before earnings? Or
Yes. So, I mean, typically we don't do that very much, but Wes and I thought that this was, we thought that the numbers were going to be good. The stock actually had moved up. It got our attention back here, Brad, here, when that's when they talked about the package, and then it failed. That's, so it,
right.
So it failed that day, and then, it came all the way back and set up, and, so, we had no idea. That was the cherry on top was the package that day right there after earnings.
Right.
But it just set up, and it screened, it had the screens we're looking for, so big cap stock, leadership stock.
BCP there too,
Yeah. So, got tight in here and got really tight, and there's the setup, and, it was a pilot position. So we're just using these pilot positions to try to get on the right side of the market and stay engaged. And by no means, is it a market where you should be 50% invested? I mean, I think, well, we're not invested we're net even right now, 12% long, 12% short roughly. But we'll go to, if the market will improve, we'll go to 25%. As long as we're making money, we'll use progressive exposure and average up. And, maybe other stocks will present themselves, but I've kind of given you the best of the best that I see in the theme that is prevalent right now. And, it's hard to do this without having a bias. So we're just trying to let the action tell us what to do. But, I think Minervini is the best on the planet, and he's been getting kicked out regularly. So he really hasn't been able to generate much traction. And so he got stopped out of his first batch of stocks, and now he doesn't have much traction right now other than IMXI. And it's just a tough environment. So, it's a tough environment. It's going to get better, but if the what hits the fan, then, and we're below that 30-week, that's going to tell you something. Tomorrow, we got to get above the 30-week for a couple of weeks. And again, that might be a fake out too. So, that's important it's important to study, what's happening in the past. All these bear markets that Wes went over today, I think it's useful to study those. But we have plenty of time to make money. You got plenty of time to have a triple-digit year when the bottom's in. And I know Ropel had a triple-digit year in 2020, and he didn't get in until 2 months after the absolute bottom was in. So you don't have to be first there. You want to buy when the odds are the greatest success, that you'll be the safest. Not, you don't want the lowest, cheapest price. You want the best price where it goes up immediately.
Right.
So I have two positions right now. I have a 20% gain in GitLab. I I bought it off the 21 day back in July. I sold a third of it already. That's June, July. You gotta go over 1 month. I bought it like 54.90. No, it's further off in July, right before the last run. You see 51.38 when it retook the 21 day after that 51.38 lower pivot.
Yeah,
No, more to the right, more to the right.
right there.
Nope, more, even more.
Oh, you
50
bought it the 21 day right there.
Yeah, 2 days after when it retook the 21 day.
Oh, cool. Okay, cool. So it came back. Yeah, great.
So
Oh, that's awesome. Right there, it came back above. So you had, and yeah, you had that pivot right there. Yeah, great, great buy.
So you know, I sold a third of it already. I always sell at a 10% gain. I sold a third of it. I'm letting, you know, 2/3 of it ride still. And I know the market is kind of iffy right now, but it hasn't even broke the 10 day. So I'm kind of hesitant to sell it. Like there's no reason for me to yet, you know what I mean? Unless, you know, I'm trying to, you know, it's coming up the right side a little bit. I'm trying to be patient with it, you know what I mean?
We're looking at it. I mean, we're looking at it. It's on our watch list. It's on our buy list. It's already in this list. So, and we're looking at it, you know.
I know it's not, I haven't been able to get into solars. I missed out on the end phase. I'm waiting for the pullback on some of them. So, you know, I'm just trying to make money elsewhere for now, but.
Yeah. Let me see what's on our watch list. I'll pull that up. Private.
Hey, Roy, can you pull up TEAM?
Oh yeah, that had a phenomenal move. Okay, and this is what we're looking at. This is our, and I've sort of got to go. This is a moving target, but this is our watch list. And let me pull up team, and then I'll come back here. And TEAM. Now this is the biggest position in PRGNX. I believe that's the fund, PRGNX, I think.
Okay.
That's their biggest position. And they've got a 10% position. That's had a major move. And you know, great action. Now this is how the leadership sets up. So this is getting above the 200 day, and you know, it's forming the right side of the base. This just needs time, you know. So this is a great report. It was received well. That's what I mean by a great report. Looks like the earnings projections next year look great. And you know, here, you know, this is like Uber too. You know, do you sell it? You know, do you sell it or do you hold it here? Do you take the profit or do you hold it? But very good.
I definitely tightened up my stop just because that's either going to be resistance at that black line or it's going to break through. And it's just, you know, it's going to do whatever it does. I don't know what it's going to do.
Roy, that's my other position is Uber.
Yours is, Joseph?
Yeah, I got it in at 29.55 the day after the earnings report. And I sold a third of that too. And if it breaks 30, I'll probably cut the rest, but I'm trying to give it time, you know what I mean?
But you know, it hasn't, you know, this is, you know, if you have a profit in something like this, it hasn't even hit the 10 day. And there's the cheat. So now it's not going to get, you know, it's not going to hit the technicians until it breaks the 200 day. It's right there. I would add it the 10 day. And then if it broke the 200 day, I'd press it. That's how I would handle it. I try to get, you know, a 10 to 15, 20% position. The action's great after earnings, but I'd want to buy it that way, you know, buy it. It's not, nothing's wrong with it. You don't have to buy it at the 10 day, but you have a nice cushion. But I'd buy it, you know, I'd press it because it breaks that 200 day. You know, it's going to go, look, that's 32. It's going to go to 40.
Yeah. I saw the 10-300 and I was like, you know, if this comes into the Oh, it wasn't 300, but 246.
Yeah,
Bad.
close enough. That's close enough for water balloons. So so you're having some of these setups like this this is I mean, it's got my attention. You might want to do a screenshot, like this is what sort of we're looking at. You know, so you know, this is a moving target as well. And so these have screened well. We're just sort of looking. We want to see what happens. Bumble's earnings come up, I think maybe tomorrow. I think Dutch Brothers, they've got earnings coming up. Clean Harbors had a good report. Clearfield had a great report. There's this natural gas stock. This is the energy stock, CWEN. So these have fit. There's Global Foundries. So these there's GitLab. You know, so these have gotten my attention from screening, and the rest of the list. There's InMode. There's that KRUS. LI failed. We used to own LI, and we sold that a little while ago at a small loss or break even. NFE, Ottertail had a great report. Olaplex, not so good today. Portillo's not so good. Sweet Green, SG got hammered after market. There's this Quanta Services, PWR, that has a very constructive chart.
So TTD had earnings, and it has it had 2 million volume after hours, and the 65-day average is 6.8 million, and it's up 18%. So if I had to take a guess, depending on how the market is tomorrow, that might actually be at 10,300. But is it too low?
Yeah.
Is it too low to, like, you know, it was 114 and now it's what, 64? Would you say that's more of a short covering, or is it like institutional coming in?
Well, I mean, they like the report, so the report is forcing, you know, the report. You have people that own this stock a lot. You know, look, you got 1,200 mutual funds.
Yeah.
Look, look at the IBD ownership. I mean, that's these are all institutions.
Okay.
So you know, the report, they blew the number out apparently, and so likewise, you're getting the move up. You'd like to see the stock go above the 200-day, and I'll put this on our watch list right now. And where's the 200-day? 200-day 68. So it's going, you know, this stock's can probably hit 68 or go through the 200-day, just like Uber and just like. What was the other one?
I think the one John was talking about. Forget the name.
Altasian Team.
Oh yeah, Team. So it was Team. Yeah, you're right. So this is, you know, so that you're going to have a great profile tomorrow.
Yeah, I'm actually interested. I'm really interested in the Bumble earnings, to be honest with you, because that thing's coming up the right side. I think there was another name in this group that had bad earnings. I forget what the company's name. Oh yeah,
Match.com.
Yeah. So, but just the way the chart looks on Bumble, I really like the chart coming up the right side. So I'm just, if they blow out the earnings, you know.
Yeah, this is I mean, it's setting up nicely. I mean, if they didn't have earnings, I would own this stock.
Yeah.
You know, I like, you know, and again, Bumble, that's the dating service where the female controls the conversation, because you know, the female decides if she wants to chat with the other party, you know, so she regulates that. You know, she's getting inundated with, I think I saw the statistic, like I think men select like 77% of all women that they see on Match, but women select like only 6%. So I guess the women are more, you know, whatever the word is, they're more selective. than the guys. A lot of
They're
females are
screening
good
better.
guys. What's that?
They're doing better stock screens.
They are. They're screening better.
They're digging deeper.
That's why females, many times, if you look at the literature, many females trade a lot better than men. I mean, not in all cases, but because they have a higher propensity of keeping the emotion out of it and just keeping focused. I've seen that's, a lot of work on that.
What do you think of Cloudflare's earnings? I know it's another one that's kind of down there, but it had a lot of volume on their earnings.
Some of these, Joseph, like if they build a base here and see the earnings are out of the way, earnings up 150%, but look at the price to sales multiple. See, it's 23. It's 20. They're doing $1 billion in sales with the price to sales of 23. 20.
Yeah,
23. So by no means is would the stock ever be cheap? So you just need to give it time. But if I mean, even next year they're going to do 8 cents. So there's no earnings power here. There's just no.
Sorry, I was just gonna say, what do you guys think of the fact that a lot of this is old leadership from the last year or 2 years? Is that?
I think it's dead. Look, Twilio's dead. 373 to 80.
But this is the stuff that's been popping in the last week, 2 weeks. So.
They have. I use a colloquial expression that I can't. It starts with the D and it has an S in it, and that's the kind of stuff that's moved. The stuff of inferior quality.
You're right.
So. So there are trades to be made, and those have had massive moves. And what makes it so difficult is, if you had a Roblox at the bottom, had all your money in it. Look there, a month ago, you had all your money, you could have doubled your account. And that's the stuff that's moved. And look at Roblox aftermarket, see down $8. And I was watching this, and just like GitLab, so I'm watching these to see, okay, who's off the bottom, who's starting a new uptrend, but you can't carry any of this stuff into the number.
Yeah, GitLab doesn't have earnings for a while, thank goodness, because I went and hauled it into it.
Unless they warn, so.
Oh yeah, that's true too. Yeah, you're right.
But that's
I like to see a little bit of relative strength. Because there's bottom fishing, and then there's the bottom.
I mean, there's Teladoc. Look, there's there's the stop down 80%. Then it dropped another, 10%, 17%, I think, on the earnings. I think Zoom. Yeah, look at Zoom. Zoom's, and this isn't even, look, it's not. This is Kathy's biggest position. And so it's down, 404 to 100. She's in it, in the 300s, and it dropped another 10%, 8.24 today. So there's no telling where, there's no telling where this goes. And see, look at the declines, look at the sequential declines in earnings. And so it's best to not, if they have earnings, they have revenues, then you put them in the wait and see category. Like I like, and I still like sort of this setup on this OLPX, where they have decent numbers, but it was off 10% in the quarter, but it's holding the 50-day. So that's the shampoo hair bond company that they have a relationship with the Ulta and the other cosmetic franchise that I don't know the name of, that starts with an S or somebody.
Sephora.
Who is that? Sephora? Sephora. Okay.
Yeah, I bought it on the 1st or the 2nd and got my teeth kicked in.
You bought
right before the first drop. Yes. I thought it was tightening up. It was looking good to me.
Well, I actually I bought it I bought it that day. I bought it on the 3rd and sold it the next day. You know, so I bought it right there at the 50-day, and I was up in it. It closed okay. And then I asked myself, why am I buying this 3 days before the number?
Yeah.
And you know, and that was a good sell, you know, the next day, just to clean it out. But I was planning on buying this in the fund too, if it took out 1823. And again, if you shake out here, I mean, these numbers are quite good. You know, the numbers are quite good. I haven't gone through the report yet tonight. Maybe I'll do it later or in the morning. But 1823, this has got my attention. See where I have the alert right there?
Mm-hmm.
See, I'll be buying this stock going over 1823. And, you know, if it holds the 50-day tomorrow and turns up, I might put on a little pilot position as well. So from what I've read, it's gotten rave reviews, but they have numbers. See, they have numbers, and that's what I'm looking for. These IPOs, I'm looking for the ones that had numbers. This really, I was looking at this APP. Now they reported today, but they made they reported earnings, I thought yesterday.
They bought Unity Software, right?
Yeah, so they made a offer for Unity Software. So this was setting up with very good numbers. Look at the earnings growth, 260%, 286. So this was on my screen, like setting up. See, if they did make the offer for Unity and see the pivot yesterday, see, I was looking at buying this one. You know, taking out 3870 right there, you know, big sell off with numbers. See, 56%, 90%, 123%. So, you know, I'm looking at those that are beaten up, that go into stage 2 uptrends. And, you know, again, for it to be in a stage 2 uptrend, it has to move at least 30% from the bottom. So just because, you know, that doesn't qualify yet, but, you know, I'm always looking for an edge. And
another dumpster diver stock that's doing pretty well is on. Seems to be seems to be getting volume behind it, and earnings are next week.
It's on my, I like this. And I just put it on our watch list right here. You can get this. This is a pretty good setup. So
Their shoes are all over the place now too.
Yeah, everyone's wearing them.
They're everywhere. So
I hear that. I hear this is the shoe to have, you know, Roger Federer's company.
Right.
And I mean, this is a very nice setup. Look how I have this trend line at 23 right there. Look, so it's up $1.09 after market. So earnings are in a week. So you could buy this breakout tomorrow. And if you have enough cushion going into the number,
hopefully it runs up going into the number, right? Maybe.
Yeah. Yes.
Yeah. And then the numbers on your side, and away you go.
This is, I mean, I like this setup a lot. You know, but it is in retail. So, you know, what's going on with retail, but there's the setup, but they have the numbers. They got to have a good report. And I think, let me see, what did Crocs do?
I think it qualifies for the end though in canceling, because it's only because it's new to North America, like relatively, that I've noticed anyway.
You mean ONON?
Yeah, the actual shoes. I mean, I haven't noticed them up until like 3 months ago.
Well, I really haven't noticed them. My daughter tells me they're the rage, and I actually needed a pair of sneakers, so I went online, and man, they have some really flashy shoes that look, you know, that are highly fashionable. I mean, I like the shoes a lot,
and there always seems to be a shoe company that really takes off, like Deckers and Crocs and LA Gear and on and on.
You know what Bill O'Neill said? He said once that it seems like a shoe company always leads each bull market.
Yeah, exactly.
And this is the one right here. So there's a great setup taking 23 out, but you've got to, I would think you have to have a little cushion because we've seen a lot of these stocks that are dropping, 10 to 15%, missing, even though they're down. But this is, if it gets above the 200-day, I guarantee you that this will get people's attention. That's where people like Roper will be buying it. And
Check out the institutional ownership on that.
Yeah, that looks good, actually. I just pulled it up as well.
So small but growing, it's small but growing. You've got T. Rowe Price in there. Wow, look at this. And you've got some heavyweights in this thing.
Yeah.
This fits a lot of the stuff that you would want, like in a perfect setup. We'll see if it works, but it's not extended. They have numbers. It's had this massive correction. You got institutions in there. This is this is some of the stuff. This is what we're looking for, really.
As David Ryan says, you start noticing it all over the place whenever you're going into a shoe store and the people start talking about it, and then it's got that hype to it as well, right?
It does.
Yeah.
They're adding to their positions too.
I'm sorry?
They're adding to their
Are they?
positions too.
Oh, yeah. Yeah, I don't, Panerai has that. I don't have how much they're adding, like how each fund is adding, but that is on Panerai's.
Well, it's
Are
on
you sure?
MarketSmith now.
Yeah,
too.
I
Look
see
at
it
the
right
bottom of the
there.
chart.
If you look under Fidelity Contra Fund, December 2021.
Oh,
or if you go
yes.
down
Oh,
lower,
yeah.
I mean,
Yeah, they're
they
showing
almost
you. That's
8x
right.
their position.
There it is. So this is brand new. They
just add that.
Man, this is fantastic.
Yeah.
Yeah, that's really interesting.
Scott Sinclair is getting that right.
This is the first time that I've really noticed this. So they just added this really recently.
Yeah.
In the last 30 days.
Well, look at that. In December 2021, they were at 1.3 million. Now, 6 months later, they're at 8.3. That's like a 6x.
Wow.
Oh, that's impressive.
That's what you want to see, right? I mean, that's to me, that's a great setup. Who else can you think of that's in this list? ONON, these types of stocks. Let me see. DOCN.
Maybe CRDO.
See, I'll pull that up in just a second. So here's Digital Ocean, and I'm tracking this. So earnings are out. See on this DOCN, and much smaller positions here. But it's what I like about it. See, they've got the earnings profile with the growth, and see where your trend line is right there, breaking above resistance. That's got, these are the types of setups that and earnings are out of the way, the number's good, and these are okay to buy and trade. This is not like buying a Zoom or a Teladoc. And CRDO. This is setting up quite nicely. And look, this is what serializer, deserializer technology. So this is this is in that telecom. Well, it's in internet network solutions, but it is somewhat attached to that telecom area. They're just buying it for the first time. Like this is a brand new pup. At least some funds are starting to get involved. This is
It looks
great
like
earnings numbers.
they might try to form a cup and handle there too.
Yeah, so here's your cup. Now you're putting in the handle. If this thing would tighten up for 5 to 10 days and then take that pivot out at 1732, you're off to the races. This should definitely be on your watch list as well. Smaller cap.
They got earnings tomorrow after market.
Oh, they do. Okay, so
Yeah.
that'll be important to see what happens there. So a move over the trend line on a good earnings report, you can get involved probably.
How about a Crocs, Roy? Like, I mean, it's making it, it's gotten beat up so bad, and their earnings seem to be, fundamentals seem to be hanging in there. I don't know.
It's so earnings are out of the way. So earnings are out of the way. You've had this nice move. It's it's consolidating properly. You got a lot of people in there. It's growth is okay this year. Growth isn't so good next year at 9%. This looks a little bit stale to me. It's been out there. It's been trading for a long time.
Yeah.
Respectful numbers, but it just looks a little stale. It's
I got another one here. It's I don't know how had good reaction to earnings. EXTR, Extreme Networks.
yeah, okay.
It's like ANET.
Yep. And this is doing a legitimately nice job of building the right side of the base there. Solid numbers, small market cap. This company's been around a long time. I've traded this stock over the years, and actually there's not much overhead. I wonder if they took this private. Okay, so no, I've traded this over the years, but there's the monthly, and you don't have much to go. There's a 52-week high breakout. So it's doing the right side. Earnings are out of the way, and it went up. This is one of those situations where it's not what the earnings did. It's, well, how did the stock react after the quarter? And, so earnings, they're still profitable, 26, 32%, 94 relative strength, which is great. And, there's some accumulation above the red line, which is your average volume. This is an interesting setup.
Got another one that's actually in the semiconductors, but it's pretty strong as PI. Impinj is quite strong.
This is what you want to see with leadership. See, it's gotten, it did get hammered, but we were in a bear markets. Bear markets, these growth stocks correct 50%. Now you've had to move off the top. You got to be careful though when you look at this. You got to be careful, because when you have moves that break like this, from experience, I learned this setup from Gil Morales, and he and I used to work together at Payne Weber, and then he went on, became head of institutional sales and research at William O'Neill Company for 7 years in the early 2000s. And he calls this the punch bowl of death. See, a big punch bowl. And, so these are stocks that get hammered. They make quick moves to the right side of the base, and then they explode. So that is this type of setup, and you won't know until it's called a late stage failed base, where it breaks the 10-day and 21-day.
Okay.
When it breaks the 10-day and 21-day, you hop on it on the short side, and then it qualifies to be a punch bowl of death, setup. So far, so good. And actually Celsius, looks a little bit like that. So, I'm eating my own cooking to a degree. See the move right up here, the quick move, and now it just needs to contain. How the stock acts in the next few days will determine.
Is that because it comes up too fast, Roy, is what you're saying? Like it just came up too, or?
Yeah, that has a lot to do with it, but it's had a big move. and maybe growth slows, but the pattern frequently occurs just like this. But it is a quick move. See, look, from 52 to 100. And so you've got to move, it's 100% move in a month, 2 months actually. So that's why it typically happens.
Yeah, I think tomorrow's a critical day for this name. The
So
volume
you got to be careful that it gaps up and craps. Gap up.
It got to get above 100 and stay. It's got to hold it needs to push up to 100 and stay above 100, in my opinion.
And I actually own this personally and sold it yesterday at 102 pre-market. Right there, because I didn't want to take it into the number, and I think I had like 1,000 shares or something, and I said, nah, I don't want to get hit for 10 or 20 grand.
It was kind of wild after hours too. I think it went down at first, and then it ended up.
I was looking at it, was down $2 at one point, then it turned green. Now it's up $2. So they had the conference call, that started at 4:30. So, the way that you would play this, guys, is the way from my experience is that, see, if it gaps and craps, if it gaps up 2 and turns negative, you probably want to exit the position because it's going to probably break the 21 day and, you can hit your safeguards. But if it takes out today's high, then we will be pressing the position. That's 100. So if you turn around, you see the stock at 101, that'll give me more confidence. And after the earnings are out, but it could be like that LNTH that gets wild too, for that day, for that one day.
Yeah, and the thing with LNTH, right? And I don't know, maybe you've done a study on this. I haven't really been able to dig in. I haven't been trading as long, but it had a gap up, right? In February. Then had a second gap up in May. So I don't know how often it is that you get like a third powerful gap and go.
Not a lot. Normally the third time you sell.
Yeah. Okay.
And typically, so you had 1, 2, 3, but I looked at it, and the reason that I didn't sell was because we're in a bear market. It's coming out of a bear market. It's got everything that I'm looking for. Maybe it's one of these, maybe it's going to be a true market winner that goes up 100% from here. Despite, there it is. And looking back, it's there, it went up. But a lot of the stocks, when you go back and you look at the data dogs and the Fastleys, they had like 2 quarters. That just shows you how difficult the market was from 2021, where, you had some of these moves. And even when you change the date and you go back and look at Zoom and Teladoc, those were tough to trade more than 2 quarters.
Yeah, because with Fastly, I remember that one. It gapped and go, but then they had that, once it topped, it got wild and then it gapped down. You know what I mean?
I do know. So Fastly, there's the
right there at 136. Yeah, and I actually bought this going out of the 117, and I got caught in that gap down, and I sold after hours because I knew it was over. I just and I remember that same day I had a big gain on Neo, and this basically canceled that out. And I was like, wow.
Got lucky.
What day was this? So that was, let me see, you put in October 2021.
And it taught me a lesson not to FOMO and chase.
Yeah. And so, so fast, what are we looking at here? So this
October, a little more, 136.
There, right there. Yeah, there's the gap. And I was in this stock, I'm sure. Actually, I may have gotten lucky. This is one that I got lucky and sold before the quarter. Yeah, I did.
Yeah, I remember you saying that. I remember that. Yeah, you did say that. You sold right before it.
I sold the day before. And and there's 6220, but I want to change the date.
And that wasn't even, it was a pre-announcement. It wasn't the actual earnings. They pre-announced. That's where I got caught.
Yeah, that's right. It was a pre-announcement. So this is the point that Joseph is making. So here's the first earnings period. So here's the first earnings period. And there's the 10-300. See the breakout right there. And so this stock, the next earnings period.
That's 34 million in June. It looks like, just based on the volume.
Yeah. So there's the second one. And so going into this was the third one, see right there. So you had, so this stocks, and that's, in a great market, I'm waiting for this. See, I'm waiting for the ones that break out just like this. And remember, look, it was up 45% that day at a 52-week high with the 10-300, the biggest volume that it's traded in history, up 45%, 620. That's not a sell signal. That is a load the boat signal right there. That's put 20% of your account in the position right there. In day two, give it, you should be in within 2 days, just like on this shock wave tomorrow. You've got 2 days to get in. And then there's your double, so, 42 over 100. And, then it obviously peaked, went parabolic, and, your sell signal, buy it on the pullback, sell it going into the next, into the number. And what's that?
I said punch bowl. Up the right, straight up the right side.
Yeah. What's that look like on the weekly? FS, let me make sure. So there's the peak. Not really. I mean, it blew through it. See, there's the move straight up, and then it continued to go. So again, so this is how this Celsius is setting up, like right here. Which way is it going to go? Is it going to go further, or you can get a double out of it, over the next, 8-9 months, or is it going to, fail tomorrow? That's going to be interesting to see. But the numbers are so, I think you're early with that. I think you're early. I think, you're early in the move because of Pepsi.
I agree.
And let me see, Datadog. There's the Datadog breakout, see on volume right there. And see, this was tough to trade too, because you can see you had this one little move to the earnings report. You had one earnings report, then it got so choppy you couldn't trade it. But there's the move on the breakout. Their earnings were a few days later. This was a big winner, a firm with the big, numbers that had 1 quarter. See, that was it, and that was the peak. But stock traded from 100 to 176, and then rolled over. So so you're looking for these, and this was a hot stock that had big numbers, and that's a buy now, pay later strategy. And they signed a deal with Amazon, and that was the peak. See, that was the peak when they did that deal with Amazon. And Upstart, another big winner. And so this just shows you how, so this stock 100 to 400 from the 10-300 day when it broke out. So that's what you should be looking for. One stock can change your life. But notice it just lasted one earnings period. Look, there's the earnings period. The second earnings period, the stock had well peaked. It was down 30% from the top.
Roy, in your first initial years of trading, because you say that you need a big position size and just one stock can change your life, but I find that as a newer trader that it's a little bit more nerve wracking to put on, big position size, 20 to 25%. So I've heard from other traders that the best way to build that confidence to big position sizes on is just to keep studying and studying the biggest winners. What do you recommend?
I guess I think a lot of it has to do with your mindset. I would rather lose money than miss out on an opportunity to change my life. So I knew that I was going to have to take 20% positions because that's how everybody did it. That's how William O'Neill did it. And he often had all of his money. Look, the guy was a billionaire and he often
Really?
had all of his money in one or two stocks. So if it's good enough for Bill, it's good enough for me, but it's your mindset. I mean, this game's not for everyone. And there's tremendous stress, but the more that you study, I mean, after doing this over 35 years, I'm as passionate now as I have been ever because I get to work with my son. And man, I just love it. So I understand you're going to have periods. I mean, you're going to have periods where that don't work for you. And, I mean, I had a big position in this. I had a 20% position in this AONY right there.
Mhm.
And I'm the guy that got stopped out and took, whatever the loss was. It was a fairly big amount of money just because I got picked off. But that goes with the territory. Stuff like that happens, and where you can get picked off. But I would think that, I mean, 5%, Charlie, I wouldn't be in a position personally with less than 5%. And I would try to get the position at 10%. And then as the market improves, then you have, you want less and less stocks. And if you want to push your money into the best performers, and I'd rather have 5 stocks and be 200% long than 10 stocks that I'm not, so convicted about. So, but I probably would, when I got started, I probably put 5%, initially. And then as your progressive exposure, as you build some profits up, then your position size changes and you get more comfortable. I probably put $2,500 in a position when I first started, and I'll put $100 grand, in something just with the blink of an eye now. So it's that's after years of doing this and establishing some profits, but it takes a while to build it takes a while to get good at this. Now, we didn't have the social media network and the tools that Richard Moglen, for example, is famous for, and Trader Lion does such a great job for. Now you have a lot of the US investment champions on Twitter, and there's a lot of good information that you can delve in there. I mean, it took me 7 years to know how to make money. So I started in 1988. I think I was 28. It wasn't until I was 34 that I really felt like I knew how to make money. It was hit or miss. Again, I told you in 1990, 1991, where I sold stocks too early, made 20%, and those stocks went up 300% and 400%.
Right.
And so it took me 7 years. And, we have the book, by Malcolm, the Outliers, Malcolm, what's his name? Yes. And so, he had the study where you've got to put in 10,000 hours before you master the subject. And so that takes you 3.5 years of 12 hours a day. And that's what you have to do. So it took, it took me 7 years, but I guarantee you, if I had the tools that are out there now, it would have been done in 3.5 years. instead of 7. But it took me 7 years to learn to make money because we didn't have IBD telling you that we have distribution days. I charted all this by hand. So, you can go to IBD and they'll tell you, if you got, is the market under pressure? Is it in an uptrend? Is it a downtrend? How many distribution days we've got? And I charted all that by hand for 20 years before, before they started making all the enhancements and improvements. So, I don't recommend paper trading, even if you have $1,000.
Yeah, for sure. Yeah.
You've got to get in there. You've got to have skin in the game. That makes you it makes you want to get better. But a lot of it has to do with mindset, but it's going to take you time. But I think if you're passionate about it and this is what you're driven to do, you can do it and you can get there in 3.5 years.
Roy, you forgot to mention that you had to call your brokerage to place the trade and and pay those commissions. I couldn't imagine calling someone up and be like, yeah, place this order right here and I want my stop right here, this many shares. Like
and I mean that's been amazing that it's been amazing the disruption in the business because of automation and productivity. I mean, I remember if I put $100,000 in Google in 2000, that it cost me $3,000 to put the position on.
Wow.
And $3,000, $3,000 in, $3,000 out.
So let's say like something happened and you got stopped out the same day, you that $6,000 gone on top of the stop.
Yeah. Yes. So the business is, never has it been better for the retail client, for individual traders, because of the tools, the trading platforms, the technical analysis that's available to you to help you make investment and trading decisions, and the research that's all online, the online that you can get from IBD and everyone else. It used to be, you'd get your information from the Wall Street Journal, right? And Barron's, and that's it. Not anymore. I mean, IBD is by far superior. Then you have a lot of, third-party vendors where you can get information like FinViz. They've got a wonderful site, and you just have a lot of tools. You're not held hostage by the brokerage firm. So it used to be you were held hostage. You couldn't get good information unless it was from your broker. Now that's been flip-flopped. So it's better than ever. I mean, this is going to be a tremendous decade. It's going to be great. And we have bull and bear markets, but we have the tools to actually do it. But you must know where you are in the cycle. And we're in the trend is certainly still down. It could turn up if we get over the long-term trend is down. It could turn up imminently, but still, you're not going to have a lot of stocks. There aren't a lot of setups. So you just have to have your head down and do your research and be aware of what's happening, and be aware, of course, of protecting your downside in case this turns into a mess. Guys, I'm going to call it a night.
Thank you, Roy.
I sure hope that you guys learned something, and thank you for attending. Pass it on.
Thanks, Roy. My first meetup with you guys.
It is.
Yeah, it was really great. Very good.
Great to have you, Brad. Hope to see you next time, and may all you continue to have great trading and investment success.
First time for me too.
Thanks, Roy.
Thanks.
Take care, guys.
Take care, Roy.
Thanks, Roy.
Thanks again.
You're welcome.